We really nailed it down to copper, lithium, graphite, and nickel. We had from the very beginning a large overweight in uranium.
Okay.
So from all the metals, let's say uranium was for a long time between 30 and 50%. Copper is done for this year. I'm not really bullish on copper prices for the remainder of this year. I think we're going to consolidate close to 4. Uranium at 80 is a great opportunity, right?
All right, Simon. Been a while since you and I spoke. This is Simon, by the way, from Torck Capital Management at torck.ch. He's calling in from Switzerland. And I do want to talk about how your guys' portfolios are doing and what you're doing with them. I do want to get to the uraniums and the nickels and whatnot and all the crazy stories that are happening right now. But first, I want to talk about the battery market as a whole, maybe. Mainly because I read a Bloomberg article this week saying that at the speed at which we're currently, well, not we really, the article is mostly focused on China, but at the speed at which China is currently building battery factories, the world is soon going to have more batteries. Specifically, they mentioned 5 times more batteries by the end of this decade than what the economy can employ. And I mean, that sounds like a dire prediction. It sounds like there should be an implication on battery metals as well. Is that something you guys follow professionally, and what do you make of this whole thing?
Hello, Antonio. Thanks for having me for this talk. Yes, battery metals and battery capacity, that's a big topic, of course, for our energy fund. Yeah, I've read the article you mentioned. They're claiming that the world is going to build up way too much battery capacity. It's difficult to judge. Of course, there have been a lot of battery factories planned around the globe, especially in Northern Americas, but also in Europe, trying to keep pace with China. It's difficult to judge if it's really way too much or if it's just a little bit too much. And if it's too much, how much? The only thing we know, and I mean, we have seen that in the last 2-3 years with the different battery metals, the whole market for the specific battery metals and batteries in itself is really still in its infancy. So it's pretty young, it's volatile, it's not a saturated market. So no one really knows how big the demand will be for batteries in 5 years, 10 years time. So no one exactly knows how many batteries do we need, which batteries. That's the other topic, right? There are many different technologies out there. And which metals do we need in what size and amount for feeding into those batteries. So there's a lot of speculation, a lot of probabilities out there, but no certainty for sure. And then it's, I mean, even if we build up too much capacity on a global scale, the question then is, does the West has access to, let's say, China produce batteries in 10 years still? I mean, with the whole geopolitics going on, the last 1 or 2 years, might be good for the West to build up its own capacity in various spaces and not rely on imports from various countries.
So essentially, you're saying you're not necessarily buying this article.
I mean, it's so difficult. Who knows? I mean, we're not even able to estimate the demand in 2 years, 3 years time. So what do we know about demand in 5 years, 10 years? I mean, and all those factors don't come to the market within 1 or 2 years. They need some time to build up, to ramp up, etc. And not all of them will be built for sure.
But what if, I mean, humor me here, what if we actually have 5 times more capacity than what we need? What would that mean for the cyclicality of your lithiums and your nickels and your cobalts? Again, depending on which type of battery we're going to go for.
It's going to be pretty volatile. And I guess we would see more of what we have seen, for example, in lithium the last 2 years. So you have the battery factories, they try or they want to produce their batteries, so they need the metals that go into the battery, huge demand. So the price for the metals will go up. Then they realize we have too much batteries. we can't sell them. You stockpile for a while, you realize, okay, our production is too high, we can't sell all of them, so reduce your production, and then the price for the metals goes down again. So you would get a lot of overshooting in both directions.
There's a little bit of that. A little bit of that has been happening already, right? Like we felt that cyclicality in lithium. Is that something you track? Like, do you track how many batteries the Chinese are putting out and how much demand there is and stuff like that?
No, not exactly. I mean, you read some articles, you make up some thoughts or some scenarios for the next couple of months for your investments, but we don't track that statistically or so.
Is that because you don't think it's relevant to your investments, or like why not?
Yes.
Okay. There's basically two ways I suppose we can go with this from here. One of which would be talking about the recycling of those batteries and sort of more long-term perspective for batteries as a whole. And then the other way we could go is Europe, specifically the elections, and I guess we'll get to the former later, but let's start with the latter because it's more topical here. It was election weekend in many European countries, as well as just for the European Parliament. Luckily for you in Switzerland, you don't care about these things, lucky you. But the Greens seem to be losing ground, which is that good? Is that a bad thing? Everybody's got an opinion on it. I sure do. But I guess, and really am just guessing here, but I guess that could influence the support and the stimulus packages for both battery and green technology producers as well as for the consumers. You know, you want to buy an EV. Maybe those green packages are no longer there. Maybe the demand drops off. And is that something you place any importance on, or do you follow it?
I mean, I see your point, and I guess going forward, or let's say in a 3 to 5 year time horizon, it can matter. Not sure if it really will in a meaningful scale. But in the very short term, it doesn't matter for politics. I mean, let's take Switzerland or many other European countries. The politics or the energy policies and all those things that have been decided and implemented are not being only supported by the green or left. They have been supported across the range, political range, I would say. So it's not going to change dramatically in the short run. If it continues like that and you really get the changes on the national parliaments and governments, then yes, some things could change, some subsidies could be cancelled, exactly what we have seen already in a couple of countries. But the support for energy transition, it's pretty broad, and it's also with the people as well.
What do you mean with the people?
Yeah, it's not only the government, or let's say the green government, that pushes for an energy transition. It's really the people supporting. I mean, the voters in that case.
Sure. So I can see that in terms of politics. What I'm thinking mostly about is like, do people really want to have these electric vehicles if the subsidies are not there, or are they being sort of stuffed down our throats?
I mean, that's one point we follow pretty closely, or where we think it's really important to follow. The whole idea when we started our fund and had the idea for the fund and the topic 3-4 years ago was really, okay, there's going to be a push for moving electrical in vehicles, in other stuff as well. You have this EU mandate to get every new car electric by 2035. So it was pretty obvious there will be a huge demand for those metals. But we already a couple of years back said, okay, that's not going to happen how it is planned, because there is not enough metal around. It's getting too expensive, and they will come back, at least they're not going to follow this plan as it's planned back a couple of years ago. So there will be some relaxation in pushes, in subsidies, etc. But at the end, you never know what people want, right? In my opinion, you should not force people to buy an electric vehicle. I think it's always bad if the government decides which technology should be used by the people, and try to implement that technology by decree. So if you really think as a society that electric vehicles are superior to combustion engines, which I'm not 100% sure it is. That's a different topic we could discuss later. But if you really think that way, then you just need to make sure that the externalities of combustion vehicles are taxed accordingly, right? And then you get the thing cleared by the price.
Yeah, I completely agree on your points of the government shouldn't be forcing anyone to do anything. Sometimes the force they use is not always as evident. Sometimes they do it through inflation and other measures. Again, just different topics maybe to be discussed in another time. And specifically because I'm thinking about the demand situation. That's kind of what we're discussing here, is the demand situation on these battery metals, and where does that go from here? And I suppose the demand for batteries and then battery metals would increase if these vehicles were cheaper, because right now they don't appear to be superior to combustion engines. But if they were cheaper, people like cheap, right? So they would go for it. How do you make them cheaper? Well, taxes is one of those things. But then the input materials of them are also one of those things. So the battery metals and your steel and your silver and whatnot should also be cheaper. How do you get that cheaper? Well, more production. How do you get more production? Well, that's when government stimulation and stuff like that would come in. Is that something along the lines of what you follow as well?
Yeah, I mean, at least what we have seen over the last decade, batteries are getting cheaper, right, every year. So on that front, it's working. But then again, I mean, if you want to have cheap electric vehicles to get a steeper adoption rate, you should just import the Chinese electric vehicles because they are cheap. But now the EU just decided to tax them. So yeah, it's like shooting in your own foot. But what do I know?
What do you make of that whole thing in the US? By the way, we're talking Europe here, but I mean, Biden came out with the 100% additional. This is doubling of the price. Just silly times. Like, you tell this to your parents, they would have never believed stuff like that are going to be happening, right? So, what do you make of the whole thing?
Yeah, look, we are breaking trade wars. That's as simple as it is. And I mean, we have had 30, 40 years of global trade and globalization, which have brought the whole world forward a lot and lift a lot of people out of poverty because the world did function pretty well. And if everyone trades with everyone, everyone wins. There, I'm pretty liberal on that view, right? So what happens now is, and it's always a two-edged sword, right? We are talking now about the US and Europe bringing taxes up to prevent Chinese stuff entering the market. On the other hand, you have China really subsidizing their production. That's the other part of the matter. That's why, at least that's the claim they have. That's why they apply taxes on it. So it's per definition not a good thing for the whole world. I guess it's worse for Europe and the US than for China. Yeah, if it's really helpful in the long run, if it really, I mean, what's the goal going forward? Prevent your people from buying cheap stuff? That's not going to work. So you want to protect your own industry? Yes, might work for a couple of years, but it will not work forever, right? I mean, unless you are willing to provide subsidies in huge amounts for the next couple of decades. And to be honest, with the government debt around in the Western world, it's not going to happen. They just can't afford it.
Yeah. China's reaction to it is also predictable, interesting, yet nobody's really doing anything about it. And that's positioning themselves within other parts of the world where they can get access to South America, Africa, getting strong and important positions within the producers of the raw materials of everything that they have to export. Do you think that's part of the trade wars?
Yes, I mean, if you open up the topic even a little bit more, then I would say China really has a strategy how to conquer the world in a very long-term horizon, and the West just lack everything in terms of strategic thinking, right? I mean, if you go back 60 years, back to the Cold War we had, I mean, at the end, America just, or the West just outproduced the Soviets, right? Until the Soviets run out of money and everything, and the whole thing collapsed. So in a simple way, right? What happened the last 20 years? China secretly or more or less openly just bought up as much raw materials as they could get their hands on, and the Western countries just ignored it. And we will end up in a world where China and its allies control the raw materials of this world. And if you control the commodities, you control the world, right? The West looks like ending up with having right now some kind of wealth and money, but paper money, to be honest. But China and its allies are owning the real hard rock stuff. And we know how this will end going forward.
How will it end in terms of prices of the metals? What again, it's might be kind of a selfish focus here, but wearing my investor hat right now, like what does that result in?
I mean, I think it's not prices should not be so the impact on prices should be pretty muted, I would say, because there's a lot of material and metals and the world is consuming it. But the thing is, who has to say in the world? How will the West, America specifically, telling other countries how to behave or what they should do and putting up some pressure for something, as they have been doing it in the last 100 years, if they're not in the driver's seat anymore? And I mean, the world in 30 years will look pretty different, because China and the other owners of commodities will dictate the ones that are buying those commodities, how they will have to behave, right? I mean, it's a pretty simplistic view, and there are not a lot of nuances on it, but in a simple way, that's going to be how it will work in 30 years, I guess.
Where I'm going with this whole thing is just thinking about the supply, again, of the story. We talked a little bit about the demand earlier, but now thinking about the supply, where it might be worth talking about what are we really talking about here when we say battery metals. And maybe you can give me your view first before we actually go deeper on the supply situation as to what are battery metals going to be in the next 5 to 10 years. It was lithium now, but we're going from NMC to, are we going to LFP? Are we going to see the sulfate things, vanadium, whatnot? What is your entire view on this thing?
Yeah, to be honest, I don't know where we're going to be in 5 years, and which metals going to be the battery metals in 5 years or 10 years. I mean, for us and our company and our focus, we really nailed it down to copper, lithium, graphite, and nickel. And I think those are the ones that are also going to be used in 5 years' time, right? Yeah, LFP batteries will be a topic. So we're going to get rid of nickel in those batteries, which will have a huge impact on the nickel price, of course. But I'm not so sure about the timing, right? In the whole battery life cycle management or the value chain, there's a lot of sunk costs in it. If you have built up your battery factory and you have all your long-term contracts with the mining companies for providing your material, you're not going to change your whole production to a new type of battery, right? Until the old one is at least amortized or has shipped in a lot of profits. So I think those cycles are slower than many people might believe when they read about articles about new discoveries, new battery types, new things that come out of the lab. Right. I mean, I'm sure there are going to be different technologies, better technologies, more efficient technologies, cheaper ones, but it will take much more time.
There was all this talk of a zinc air battery last summer. All these things just kind of sound funny to me, but they're a reality, I suppose, technically on paper, these studies that they come up with, but they really are papers, right? They're nothing more than papers. And how long does it take for something to go from paper to commercial adoption on a global scale? That's kind of a tougher question to answer, and that's why I tend to ignore these things.
Yeah, we as well. I mean, as soon as you see, okay, some new technologies is at, let's say, 3%, 5%, 8% of battery market share, then yeah, of course it has an impact, and it might impact your portfolio. But as long as it's not really meaningful in terms of market share, no, it's not relevant to us in our context.
So market share is basically somewhat of a smell test for you. And where I'm coming from with that is that a lot of these companies that I would look into, they would make these fancy presentations and, tell you, oh, we're going to go mining for this obscure metal that is going to be the next battery thing. And so your smell test is just to look at the market share, or like how do you deal with opportunities like that?
I mean, let's say currently we are not interested in all those new fancy metals at all. Be realistic with the metals we have, where you also have a market. You have let's say a couple of companies at least. So our problem is always we are not going to invest directly in the metal. We invest in companies. And yeah, of course, if like I have no idea, maybe vanadium is going to be the big battery metals in 10 years, and you invest right now in the upcoming vanadium miner, yeah, good choice. But for us, it's too early. Yeah, in the companies in that early stage.
Okay. So what are you in again? Would you say copper, lithium, nickel, graphite? That's it. Just these four?
And uranium in the fund, but that's not a battery metal.
Yeah. Right. It's in the same fund though.
Yeah, it's the same fund.
Okay.
And
then the other
it's
fund,
energy, so it's not battery, it's energy.
You should have called it, what I'm calling this show is transition talks. Transition both because those are chemically transition metals, but also it's because the energy transition. So maybe you should steal my idea. I'll sue you when you get filthy rich.
Our fund is named Energy Transition Fund since
Maybe you should sue
years. So
me.
we have been
Maybe I
earlier.
stole it from you without knowing that.
Yeah, I'm gonna sue you.
I hope not. But
No.
good. So well, these things. Are you just skeptical on technology development as a whole, not only within the batteries? Because just again, going back to the supply story of it all, we're constantly going to see these things like, seawater extraction of lithium is now becoming a thing. Was it this week? I read this week. I think I read an article that we're going to try and extract something else besides uranium's being a thing, but now we're trying to extract lithium out of it. We're trying to pick up cobalt from the ocean floor and stuff like that. Is that something you pay attention to?
Yes, I mean, we are not against any technical advancement or changes, quite the opposite. Yeah, I mean, I've read a lot of articles about gold mining in space as well. I mean, there are a lot of technologies and a lot of possibilities, but has it really an impact right now? I'm not so sure. I mean, one thing I could really imagine is lithium getting extracted by wastewater from oil fields and gas fields, right? That's something, I mean, they treat the water as waste, where there's a lot of lithium in that water. So that's something that's for sure gonna have an impact on lithium going forward, and the way how we get our lithium, right? But this whole seawater, I'm not so sure if you get anything out of seawater in a meaningful way.
Yeah.
But yes, I mean, theoretically, yes, but practically, no, or not yet.
Again, most of these things are papers. So how long is it going to take to get it from paper to, and we have examples like I'm thinking of Robert Friedland back in the day who pioneered heap leaching of gold, often of tailings. And this is kind of the same situation with the oil companies, their water and lithium. Is that what kind of a timeline do you give to something like that to actually become a significant part of the way we supply lithium?
I could imagine that this specific technique will be implemented pretty soon, because you have the oil companies that now realize instead of waste, we have something being worth something, and they have the money and they have the technological understanding of how to implement things. So if they push for that, that's going to be rather a fast one. Yes. I'm not so sure about the pricing or how efficient it is, how much it will be, what they can deliver. But I mean, for sure, and it's just going to add on the price pressure on lithium. And in lithium, we anyway have the issue that let's say the upper half of the cost curve is going to have some issues in the next months and years ahead. That will just add some more pressures on them.
Well, I'm trying to find that article that I read it in, but they explain it. They explain it in an interesting way, which is, I always wonder why. I mean, the guys down at South America seem to produce lithium from brines at a negative operating cost. Like it's almost free for them to produce it, right? So why even bother to look for other ways of producing lithium if we can already do it rather cheaply, and we have a lot of it too?
Water. I mean, down in South America, with the brines, it's about water, right? It uses really big amount of water in a region where there's not that much water. So that's the main topic, I guess.
Yeah, that's one part of my smell test is when someone's pitching me a story down in South America. One of the first questions is water, because if you don't have enough of it, it's a problem. If you have too much of it, it's a problem. Not too much of a problem in South America. Of course, most of the times there's no water, but yeah, water is a huge thing. What about another supply of the metals could be recycling? That's something I wanted to talk to you about as well. If we do actually go in overcapacity of battery production, not battery metals, but the battery themselves in China and on and on. I mean, these things after the useful life, which is actually not that long, they still have useful metals in them that could be recuperated. What do you make of the whole recycling industry?
Yeah, I mean, I think it's really necessary. Just first of all, for the sake of the environment. I mean, every metal that we can recycle should be recycled in as high capacity as possible. The first thing is cost, right? For a lot of metals, it costs you more to recycle it properly than it costs you to dig it out of the earth, right? So I guess we're going to see much more recycling as soon as the prices for digging out the metals getting higher. Right, so the costs for mining go up over time. We have seen that, especially in the last 2 years. Price for the metals go up, so recycling relatively will be more attractive. And then it depends on the metal. Not every metal is as easy recyclable as others. So copper, for example, is pretty easy, pretty good recyclable. Batteries have a huge issue. I've been following a story in Switzerland with a small company that started recycling batteries. The biggest issues for them is after they have built up the whole line for recycling, all processing steps, etc. They have to make sure that the battery they got delivered for recycling has the same input metals in it always, right? So as soon as you change your battery type, back to the discussion we had 15 minutes ago, the recycling factory has an issue, right? Because they have to change as well, and that's costly. So recycling batteries, in theory, it works pretty well. You get a lot out of this black mass, which it is, what's going into the recycling factory. But on a large scale, it's cost intensive and it's difficult to change.
So that's not something you guys are interested in investing right now?
Not right now. We have discussed in the past and might take it up again in the future to start, let's say, a technology fund which invests specifically in such technologies. So let's say aside our energy transition fund, which invests in the miners of the metal, a second fund which invests in technology that drives the whole story. Yeah.
Okay, but that's it. When you haven't started that yet.
No,
When
no,
did you guys start the energy transition fund actually?
That's now 2 years and 9 months, so
Okay.
close to 3 years now.
Is the performance of that public? Or is that like, how
Yeah,
does
it's
that work for
public.
you guys?
That's on our website, so everyone can just go to our website and go to product info, and then you get a monthly comment from our side with all the figures from the fund, and some short comments to the markets and to the fund. Yeah, that's publicly. I mean, last year we have been up about 20% in the energy fund, and this year we have been up as well until end of May. Yeah.
Okay.
Not big, but it's slightly up.
It's asking me to confirm that I'm a Swiss resident, which I'm not, unfortunately for me, to read it. But what's your guys's okay, so 20% last year, but you're generally, since you started it 2.5 years ago, you're still up?
Let me check the figures. Yeah, in the dollar share class we are up. Checking the right figure. Give me a second. Yeah, so dollar share class have been up about 20% end of May.
Like since you started.
Since the start, yes.
Well, that's interesting because you basically started at the top of the lithium market, right?
Yes.
Okay, so how did you end up being up? What lithium is down, what, 70%?
We had from the very beginning a large overweight in uranium.
Okay.
So from all the metals, let's say uranium was for a long time between 30 and 50%. Lithium we had at around 10%, and the other battery metals as well. So we profited mostly from the bull run in uranium.
Okay. Well, what's that breakdown looking like today?
We just changed it now the last couple of days to be open. We reduced uranium end of February.
Okay.
When we crossed the $100 mark, we start to take profits and bring the exposure down. But then in March, yeah, it was March, I guess, we start to build up a larger lithium exposure. We thought, okay, bottom seems to be in, or at least we have had quite decent sell-off in lithium, in the metal price, but also on all the miners and developers and explorers. The first ones of the producers have gone out of the market or back in care and maintenance because the costs have been too high, which is usually a sign that we're, let's say, close to a bottom in the pricing. So we ramped up the lithium exposure, and it didn't really, it haven't went lower the first couple of weeks or first 2 months, but didn't really catch up. And now the last couple of weeks, we just went down again. And now I think we're even lower than in February. So we cut that exposure as the rally, let's say the turn in the sentiment and the market hasn't materialized as we have expected. So we're back down in lithium now below 10% again, and are now ramping up again uranium with spot prices in the low 80s. That's the region where we think you need to buckle up again.
Okay. So do you want to bring the uranium back to an exposure of like 50%, make it half the fund?
Not so sure if it's going to be 50. Right now, it's just increasing it now. I think we are about 35% uranium, and I could imagine that we go higher in the next couple of weeks, but not so sure about the end target.
But so you're
work in progress.
But I think you're doing it wrong, because I was told that you have to buy high and sell low, and it seems like you're buying low and selling high. I don't know if that works. I haven't tried it yet. Maybe I should think about trying it. But anyways, so 30% is uranium, about a third is uranium, 10% is lithium. That still means that I don't imagine graphite is a huge exposure. So that means that copper is a rather big portion.
No, we cut back copper as well. Copper has been close to 20% with the decent run we have seen from the beginning of the year until April and May. We cut that back. It's close to 10% now. Graphite is below 10. Right now we are carrying, let's say 25-30% cash.
Wow, that's really high. How come?
Yeah, that's just because we sold out of lithium and now just started getting back in uranium.
Oh, but you're not planning on carrying it. It just happens that you have
it.
Yeah,
it happens.
Okay.
I mean, if we don't see any of our metals getting higher in the next, let's say 2 or 3 months, then we might carry quite a decent amount of cash for a short period of time until we find some new interesting stories, right? I mean, at the end, it's about preserving capital. And if we think everything goes lower, then it might be decent to cut the exposure.
Okay. Is it how many companies do you have in that whole fund?
Right now it's 18.
18.
We
Okay.
closed a couple of the lithium companies. Yeah.
Is that something you talk about publicly? Like, can you talk to me about names?
We prefer not talking too much about names. But I can tell you, for example, one of the lithium companies that we have not closed and we stay in because we think it's really a good company with a good lookout going forward through the whole cycle is Petro Battery Metals.
Okay. So really like high market caps.
Yeah. For Explorer, yes. Yes. Yeah.
But do you have a market cap cutoff? Like if it's something is like 2 million, you're not touching it, or like where does that end?
You mean on the lower end or the upper end?
Lower end. Oh, both. Yeah, talk to me about both.
So for the energy fund, we decided that we're not going to go into too low market caps, but not because of the market, but rather because of liquidity, right? On the upper side, I mean, the sweet spot for us is between 50 million to, let's say, 1 billion. But in some of the metals, there are not so many companies around. And if you want to invest in a producing company, you might end up with one that is larger than 1 billion, which is not an issue in itself.
Yeah.
It's really, I mean, at the end, we decide how much exposure do we have against which underlying metal. And then in a second step, we decide, is it rather on a producer or developer, or is it rather on exploration companies, early stage? And dependent on that, we decide which companies it's going to be.
Okay, so you make a framework first at like what part of the Lausanne curve, if you will, you want to get involved in, and then you start getting in. That's why I ask you really about the names, not necessarily the specific names, but I just kind of want to get an understanding of the structure of your portfolio. Like, where's the and if we take it separately, we can start with uranium. Like, what's the focus of uranium? Are you going for the producers? Or are you near-term producers? Like, where's the bulk of the portfolio?
We have the largest one we have in is a let's say near-term producer, or it's a developer. From a market cap perspective, that's the largest one. We have some smaller producers in as well, and then some exploration stories. We haven't touched yet Cameco or Kazatomprom because they have been too large for our focus. I mean, in hindsight, Cameco would have been a good buy, right? Been the outperformer, surprisingly, and still is. But we guess now, as soon as we're going to see the next leg up in uranium spot prices, I guess the leadership will move down from the larger ones to the, let's say, middle ones.
Why? Why do you think that is?
Because with the first run that we have seen the last 2 years, and uranium spot coming from the low 20s up to 200 and now back to 80s, the general investor who is not into the topic at all just invests in the big companies where the liquidity is, or he invests in ETFs, right, or some funds. But then again, the large ETFs are heavily skewed as well to the large companies. So those one have seen all the inflows. And now, as the market has gotten some attraction, a lot of more. I mean, it's absolutely crazy. When we started the fund 3 years ago and talked about uranium, people looked at us like we were crazy, right? Yeah. Who is going to invest in uranium? Are you crazy? And now, only not even 3 years later, it's hey, I should invest in uranium because everyone is building nuclear plants, right? So where can I buy uranium? So now we get a lot of more interest from potential clients on our side, and I guess it's the same across the globe, right? A lot of investors, family offices, hedge funds, etc., who couldn't care less about uranium 3 years ago, are now really looking into the market, buying into the market, and they're not going to just invest in Kazatomprom and Cameco.
I wonder if that's true. That's been my belief as well. But I really wonder if that's true, because the reason why we really saw people, flocking to the big names was, I believe, liquidity, because the market is just very, very, very tiny. You have any fund of basically any size, you cannot go for the 10 million market cap companies because you're going to move the price 200% in a week if you take any meaningful position as a fund. But that's still the case. I mean, the liquidity, the TSXV is still struggling with liquidity on almost any level, and uranium's no exception. So I wonder if the spot price, when, I believe it's more a question of when the spot price starts going back up again and money starts coming back into the sector, is it not just going to go back into the next gens and the Camecos?
Yeah, I guess after Cameco and next gen, it will go down to, let's say, the smaller producers and the larger developers like Denison, Encore, you name it. Yeah, they're going to see liquidity, but and it's always the same story. As soon as you get the money coming in, you get a lot more trading volume as well. That's the same in every market. As soon as people getting attracted to the market, you get the liquidity, you get the volatility, which attracts more liquidity. You get more funds set up, which adds also to liquidity. So if you really get the market going, liquidity won't be an issue. It's going to be an issue if you have been invested in a, let's say, not so liquid company and your view is not going to materialize and the market is not picking up and prices don't go higher, then it's difficult to get out of the position. But if you're right, you're getting out pretty easily.
So you think explorers that have decent liquidity is where the action is going to be next, basically?
Yes.
Okay. It's frustrating though, like looking at these things, looking at the, you look at the uranium price chart, looking at it right now, it goes from lower left to upper right, which kind of tells me, okay, I was lucky, but I was also right because I was lucky on the thesis. Like I kind of looked into this thesis back in 2018, and it turned out my belief and support for nuclear and whatever worked out. The price is much higher. It's no $18 no more. But then I look at 3-year charts, or well, it's now actually 6 years. But so yeah, I look at long-term charts of some of these explorers. They're either flat or they go from upper left to lower right, so the exact other way around. And that's an issue in and of itself, because while the fundamental thesis for uranium is still strong, both supply and demand sides check out, the fundamental theses for these explorers get tougher and tougher the longer their stock price stays lower, because that's their cost of capital, right? That's their money. Their stock price is literally their money. Typically wouldn't matter for the Amazons or whatever where their stock price is, but with these companies, that's their oxygen, it's their lifeblood. So how do you deal with that?
Yeah, I mean, that's really one of the issue in the whole, let's say, mining market. It's so small. I mean, market cap of all uranium companies together is so small compared just to one tech company. It's ridiculous, right? And the same is true for most of the commodities and the respective companies. Yeah, at the end, I mean, we know mining is a difficult business, and not every explorer that starts exploring and drilling some holes somewhere will end up being a huge profitable mine. So it's in the nature of this business that a lot of companies will go bankrupt or might be taken out by some larger companies, right? But I guess the failure rate of exploration companies is quite high. In that sense, it makes sense that not all of them are just moving up together with the metal. So people still need to have the conviction that your company is going to make it, or at least progress so far that they're going to be taken out. And so what do you need? You need management which is able to progress the company, and you need a project that's going to be worth something in, let's say, 5 years time. Otherwise it's not interesting to any investor. And at the end, that's what we and all other investors are doing in that market. You try to figure out which one is going to be successful, and that's the second condition. You have to be not the only one believing in that company, because if you are the only one, they also get no money and the share price will go down. So it needs to be some kind of consensus view that this company is going to be successful, and those companies will succeed because of that narrative. So it's like a circle. It's kind of Yeah. So the price creates the narrative, and the narrative creates the price. If you have to, I mean, let's take, for example, in the gold space as Snowline.
Yeah.
I mean, this project, everyone agrees, has merit, good company, good management, good resource. They will be taken out someday, or they're going to build themselves, but this is going to be a gold mine in the future. So Snowline has no issue with raising money, not at all. Right. And there are some more projects in the different metals which have the same good condition. And then you have a lot of companies that don't get the money, or just at lower prices and lower prices and lower prices. That might end up also as a successful story, but it's getting difficult, I agree. And some companies, I really believe, just go down into bankruptcy at the end just because no one believed in them, which opens up a lot of opportunities for, let's say, some larger players, smart players that know the story or the deposit or the company and buy it up for cheap. I mean, that has been the tactic of some of the larger miners already. They wait and wait. I mean, let's say in the last cycle, in the 2000 cycle, explorers or developers have been taken out much earlier by the majors. And now the majors, with the market as it is, as you stated, the majors are waiting much longer. They don't need to fear that someone else is taking out the company before them, because no one is taking out not no one, but M&A is still pretty small. So they can wait, and even if the price falls and the project goes down, even better for them, they got it cheaper. So it's a little bit crazy if you think about, but that's how it works now. And I guess it will change going forward with the whole cycle. In 5 years' time, the discussion here will be different, I guess.
So you're basically saying, look for something that the market wants. And I suppose a follow-up question would be, what is the market looking for? Like, what does the market want? With Snowline, it wants, whatever it is, 200 meters of 1.5 grams of gold. But what does the market want with uranium? High grade seems to be working, but is that always going to be the thing? Irrespective of how deep it is sometimes, or how brief the intervals are. But yeah, I mean, what does the market want? What do you think?
I think that is changing as well, right? I mean, the mood in the market is changing. For, as you said, let's say for some periods, grade is everything. Then you have to be in the high grade projects, and no one cares about it's out in nowhere, and you have to build some 500-kilometer road to access it properly. No one cares because it's high grade. And then suddenly, or over a pretty short time, it might change, and everyone is looking for economics. Oh, is it really feasible? Can we mine there? Do we get the people there? Do we get the permits, etc.? And no one cares about how high grade you are if you're not getting the permits, right? Or have some issues with First Nations, or are out in nowhere. So that's pretty interesting, and that's not something you can plan ahead. You just have to adopt as well. At the end, it comes down to, let's say, a metrics. I like to look at it like a metrics. The project in itself needs to be good in terms of economics, right? And everything else around the project. But you also need the management, which is able to proceed with the project. And you need the mood in the market to be willing to pay up for such projects. And if you get all together, then you're in the sweet spot. But this sounds much easier than it is in practice.
It is. The question also is just how many of those projects do we really have out there? And I think the answer is not many.
Mm-hmm. Yeah, depending on the underlying, yes, absolutely.
Yeah. Gee, what do you do for I believe we talked lithium, uranium. What do you do for graphite? That's always been kind of an interesting angle to your portfolio, I believe. You don't hear anyone ever talk about that. So the question is, does the market even want graphite investments?
Graphite is pretty difficult to us as well. I mean, we have a look in let's say the 20 or 30 graphite, but since half a year, maybe even longer, we are just invested in one graphite company, and that's it. First of all, because the market is not paying up for graphite at all, and for graphite companies. and second, because China is really dominating the market. You have about 75% of graphite coming out of China, and then you have Madagascar and Mozambique as two other places where graphite mining is big, and those are, from a, let's say, investment perspective, more difficult for us to invest. That's something we don't push. So you're left with only a handful of possibilities.
What would that be again? You probably don't want to talk specific names, but what do you? Yeah, what would that look
for
like?
us, it's I mean, for us, it's a Brazilian project that should be start producing in the next quarter.
Good.
So try to catch the re-rate there.
Good. When do you think next time would have to be for us to talk, if the condition for us to talk would be that we're more positive as we speak? As in, when do you think the market is going to look better?
Look, I mean, it's difficult and it's funny on the other hand. At the beginning of this year, I've been really, really positive for all the metals in our fund. I really said, okay, 2024 is going to be a huge year for that fund. Uranium will go much higher. Lithium will find a bottom, goes higher. Copper will go higher. Nickel, graphite was not so sure, but I thought it's going to be a great year for battery commodities, battery metals. Almost 6 months in, I'm not so sure anymore. Copper, we have seen the run, right? But I think copper is done for this year. I'm not really bullish on copper prices for the remainder of this year. I think we're going to consolidate close to $4. Uranium, I'm still pretty positive. That's why we're ramping up that exposure. Lithium doesn't look like you need to be into lithium decently for the next couple of months until the market turns again. But right now it looks pretty weak. Graphite as a metal, I'm not bullish, and overall with the companies neither. So there's really just this one project where I think it's worth to be in. And nickel goes into the same basket, I have to say. I mean, if you see, we have some internal, let's say, indices on companies with the respective metals, and they're just going down. It's really just, as long as the broad market or the, let's say, investable companies for us in some are just going down, no need to invest largely in that market. Just rather wait for the turn. So I would say for this year, it's uranium and mainly uranium. But towards the end of the year, I guess we get another chance in copper after a longer consolidation. We might get a shot again in lithium. And I mean, look, I'm not a fan of guessing what's going to be in 3 months or 6 months. I'm an investor or a trader, and if the market turns, I turn as well.
So, would you, in the meantime, summer is coming along too, and that's kind of tough too, right? So in the meantime, do you just stay vigilant, stay in cash and you pay attention, don't make too many moves? Like, how do you deal with that wholesale? Because it's just that cash position that you told me about that kind of hangs at the back of my head, makes me think like, I probably wouldn't be able to sit on that much money. Like I like deploying it, I guess.
Look, there's a famous word on trade. The money is not made in the buying and it's not made in the selling. It's made in the waiting. And I mean, I'm trading professionally for more than 20 years now, and it's always, if you have this desire to invest somewhere, it's not going to end well. You rather try to wait a little bit longer, be more patient. It's going to be better for your performance. And this goes both ways, right? If you are in cash and you think it's not the right time to invest, then stay in cash, even if it's boring. And if you are in a winning position which goes well, stay in. Don't try to do the first take profits too early, right? It's always nice to take profits, and no one loses money while taking profit, but you're losing out in even bigger profits. So there as well, patience with your position as long as they go into direction.
What do you think is gonna take to change that direction for lithium, though? I think for uranium, it's mostly just the seasonality of it all, or just market fluctuations. But lithium seems to have larger issues. You say that for the foreseeable future, don't touch it, or that you're not going to touch it at least. But what is it going to make? I mean, what has to happen for you to go back to the lithium market?
Yeah, at the end, the underlying price needs to go up. That's for sure. And at the end, I mean, even in lithium, you can invest in companies, but I guess it needs to be in companies that are profitable on these low price levels. So if you go into producers, you need to be in the very low, the lowest quarter of the cost curve. You can also invest in exploration and development companies, as we are still. If companies are really finding good deposits, getting larger resources, their share price will go up as well. So, but it's always the same story. If you have the tailwind from the underlying metal, everything seems to be easy. Everything goes up. If you have a headwind from the underlying metal, it's much harder to find winning positions, and you have to be much more stringent in your due diligence and keep positions smaller, keep less positions, etc. Yeah, that's the nature of the business here.
Well, I guess we'll catch up in a couple of months and see if these things are
Yeah,
changing.
sure.
Hopefully they are, because you're describing a rather grim picture. I mean, what
It's
else
not,
is there?
Don't get me wrong, it's not grim. It's just you need to focus on things where you really see where the opportunities are. And I think right now uranium at 80 is a great opportunity, right? I mean, that's now spot is close to the long-term price. It's still, I mean, 2 years ago we spoke about incentive price in uranium for new projects coming online is about $60, right? I would go as far as saying incentive price for new projects is going to be above 100 now, with everything that happened in the meantime. So, gonna buy uranium in the low 80s. That's going to be a good trade in a 1 year or 2 year horizon. So I'm optimistic on that specific metal, but that's the advantage here in our fund, that we're not focused on just one metal, but we have we're pretty wide with a handful of metals, which allows us to switch between the exposures.
Right. Good. Well, let's wrap it up, Simon. Maybe next time we'll talk. We can talk about some of the other metals that we didn't talk about that you're not into. But I kind of know your take from last time, sort of on the manganese or cobalts and whatnot that we have out there that you're not so bullish on. Maybe next time we can talk about these things. We haven't talked about tin either, but again, there's not too many opportunities, I don't assume, for you guys as fund managers there either. But no, it's been a good talk. What am I forgetting to ask you, though? What did you want to talk about that I'm not bringing up?
Yeah, there was a lot of topics we could talk about. One thing that went through my head the last couple of weeks is really, I mean, the world is looking to China, especially when it comes down to copper and the economy in itself. It's all about if China economy is growing, then copper prices go up, everything is fine, right? But I get more and more the feeling we're looking into the wrong direction. Right, and going forward, I mean, China has been the driver for the last 20 years, 25 years for the whole world economy. But I think going forward, we should rather focus on India. I mean, even just simple terms of people, China has surpassed China in the number of people, and is still growing. China has declining citizenship. So in my opinion, India is where China has been 25, 30 years ago. And if you look out from where the demand for your copper and other metals will come from in the next 20 years, India is the place, I guess.
Good. Yeah. Well, thanks, Simon. I'm gonna let you drop off now. I know you have to go, but this was a good conversation. It's been too long since we've had our last conversation, so let's not make it too long before our next one. Thank you so much for doing this. It's Torck, TORCK.ch for people listening who want to know more about Simon. So yes, thank you so much for investing your time with me, Simon. I'll let you drop off now as I'll just get into the CEO barbecue portion of today's transition money. Transition money? No, that'd be real money talks. I'm missing it up now. Transition talks. But first, there's a warning on your screen right now, as there always is. I need you to read that. It's not just your typical cookie cutter disclaimer. This is actually important for you to read and understand that, especially if you're new to the sector. But even if you're not, read it and understand how these things are. Because first of all, I'm here to make money. Okay, it's no secret that here at Resource Talks, we make money from this channel, right? We make money by interviewing company CEOs, most of which don't, but some of which pay for the production of these interviews. But at the same time, we're trying to be different here because at Resource Talks, we try not to hate you. What that means specifically is that I would like you to be aware of the fact that there has been a payment made, but I'd also like you to be aware of the fact that the companies, albeit paying or non-paying, they're probably seeing their participation in this program as a chance to do some marketing. Pretty much any company communication that you're going to see out there is marketing. Okay, so start by understanding that. But also be aware of the fact that this and other channels who interview CEOs or talk about companies, we typically earn our money by charging for the creation and publication of these services, even though some, dare I say most, will not be as vocal about it. Some may not even tell you that that's the case. So yes, I don't make buy or sell recommendations because there is obviously clear conflict of interest when with the previous things that I told you about. Many will do that, and so I want you to be aware of that fact and just approach company-related content as marketing. But also, although I try to do a decent amount of research, the Research Talks interviews really are simple. There's three rules to getting an interview on Resource Talks. There are no questions off the table. I get to ask whatever I want, whenever I want, however I want it, no matter how obnoxious or annoying that might be. The companies get no questions up front. I'm not going to send them a list and say like, hey, this is what I'm going to ask you, be prepared. And I'm not going to say, hey, send me some questions that I can ask you, because that's something that unfortunately also happens with these interview channels a lot of the times. And then the third rule is that they get no editing rights. Like if I want to, if I want to draw a mustache on them, I can do it. I'm not necessarily going to do that, but those are the interview rules for Resource Talks. And so although I'm trying to do research and those are the rules for me, I still need you to look at these things as advertisements and not as research, and least of all as recommendations. None of us know what we're doing. None of the people who do these interview channels, we know what we're doing. If we knew what we're doing, we'd probably be investing in these companies for a living instead of providing them services. So just understand that there are no guarantees in investing. There's risks in investing. And the only guarantee that I can give you is that there's going to be forward-looking statements in these conversations. And those are conversations that are general and impersonal in nature. They're conversations that contain hopes and dreams for future events that may or may not take place, depending on many different factors, most of which we probably don't understand. Be aware of that, and please talk to a professional investment advisor before you do more research, which you should do before taking your own decision. Go to setterplus.ca, where you're going to find the company's official filings. Read them, eat them, put them on your wall, look at them before falling to sleep, and make your own decisions. Again, there are disclaimers on your screen right now. If you don't enjoy losing money, read them and be careful out there. That's it. I'll shut up now. And with all that said, I will be going into the first CEO barbecue for this week, for which I'm going to have to travel to Sudbury, Canada, to look at a couple of nickel copper projects and hear about them from Jason Jessup. He's a president and CEO of Magna Mining. The company is listed as NICU, which is nickel and copper, I guess. So NICU on the TSXV in Canada, where an average of about 200,000 shares trade each day, with a 52-week high of 93 cents and a 52-week low of 37 cents. With a market cap of about $130 million and about 164 million shares outstanding today, this is an 80-cent stock. There are 36.7 million warrants and 10.6 million options and RSUs combined, leaving us at about 210.5 million fully diluted shares. 10% of the company is owned by management and directors. Another about 50% is believed to be owned by institutions like Dundee corporations. I interviewed John, by the way, a couple of months ago. I'd probably link that video somewhere here. We mentioned Magna too. Hawks is in there, Haywood's in there, and whatnot. Other big names that you'd probably recognize that are probably on your screen right now. And that leaves us with a little over a third of the company in the hands of retail investors. Looking at the latest balance sheet, which is dated March 31st, the company had about $9 million in current assets, most of which, $7.5 million to be specific, was in cash and cash equivalents, with over $1 million of account receivables and, of course, small portions of a prepaid expense and maybe some investments as well. No long-term debt, but there was about $2.3 million of account payables and accrued liabilities in the balance sheet. And the same financial statement from March also tells me that on average, over the last reported 3 months, Magna recorded about $1.3 million per month in operating expenses. So that's about $4 million in total for the quarter, over 70% of which was spent on exploration and evaluation, moving the assets forward, with drilling representing about half of the total assets spent. So G&A, and that's excluding share-based compensation here, came in at around $370,000 per month. Again, about 30% or so of the total spent over the last reported quarter. I trust you know this, but I'll just say it just in case. This is nothing more than just a snapshot in time. In this case, specifically at the end of March this year, and the finances will have changed by the time you're watching this. So please do go to the company's website, as well as setupplus.ca, to look at all the numbers yourself to make sure that you're getting the full picture. Fun stuff aside, let's talk about the assets here for a minute, because the first thing I see on the website when I open up Magna's website is that their goal is to become North America's next nickel and copper producer, which is, of course, a big claim, and it's something that we're going to be talking about later on in the conversation. But the idea here is rather simple. Not easy, but simple. Magna wants to build what is called a hub and spoke model, where multiple assets are feeding one central processing plant, essentially lowering the cost because you don't have to build a mill at each one of those assets. And they're specifically focused on doing that again in Sudbury, which is in Ontario, in Canada. And the assets are there, the head office is there, and the team resides there, and so on and so forth. It's really a Sudbury-focused company. And the strategy to get to that hub and spoke production model over there in Sudbury is by focusing on the Crean Hill project first, without building a mill there, but selling bulk ore to another party and turning revenue that way before having to pay for the bigger expenses, for that being, again, the mill, which is expected to be built at their other projects that I'll tell you more about in a second. Now, Crean Hill is a past-producing nickel mine. The two projects that the company has, they both are. There's a current NI 43-101 resource estimate on Crean Hill, though, and it hosts about 17 million tons in the indicated category at about a % nickel equivalent grade, and that's nickel equivalent because it's, again, typical for Sudbury, but it's derived from nickel, copper, PGEs. There's some gold as well. And this is the open pit setting of it all, and then there's another almost 15 million tons in the indicated category of the underground portion of the deposit. And this one is at higher grade. That's at over 2% nickel equivalent, with, again, a comparable breakdown to the open pit resource. All of this was included in a 2023 PEA2 showing a 15-year LOM done at $950 nickel, $350 copper, and $1,000 platinum, generating a post-tax NPV8 of about $230 million, with an IRR of 23.4%, potentially coming to fruition after only an $81 million upfront capex and $250 million sustaining capex. Now, two things here, though. First, there is an alternative processing scenario which significantly improves the numbers. Against probably on your screen right now. Pretty much all the numbers get improved in that scenario. And second, there has also been, and there will be, more drilling on the project since this PEA was released. So again, something that will be discussed hopefully later on in the conversation. But these numbers might look different in the not too distant future. So yes, exploration is part of that growth strategy for the company here too, because there is a 25,000 meter drill program currently underway, partly targeting expansion of the mineralization and new discoveries in the footwall of the Crean Hill deposit, which is important and again will be discussed later on. This is not the only project, though, as I indicated earlier, and the hub of the hub and spoke model that I told you about is actually expected to be at the Shakespeare project. This is another past producing mine. And this one is at the feasibility stage, with the majority of the resource being open pittable. This one's a bit smaller, lower grade too, so there's about 16.5 million tons of indicated resource that's open pittable. It is lower grade than Crean Hill. It's at about 0.5% nickel equivalent. and the equivalent made up by the same thing, so nickel, copper, PGE. And there is also a small 3.8 million tons of an underground resource to, and again, about 0.5% nickel equivalent. But so the capex here is higher too, because this is where the mill is going to be. So there's an over $230 million capex based on a 2022 feasibility study. Something that we can discuss later on. And then again, this is mining development. It's hard, it takes time, and it takes strong nerves, I suppose. Which actually, Jason, might be a good place to start the conversation, because you had initially planned starting test mining just to see if it's worth having strong nerves, I suppose, with a bulk sample being completed or expected to be completed by the end of Q2, which is in about 2 weeks. Looking at my calendar here, how's that looking? And are you going to make it on time?
Yeah, well, a lot of questions there, but to get started, yeah, we will be on time to get equipment mobilized out before the end of this month. We're going to start moving around some rock, getting things prepped. The drilling and blasting part of the surface bulk sample at Crane Hill will start in July. It might go into the beginning of August, and then that 20,000 tons of ore will be shipped off-site to Glencore's Strathcona mill, where we've announced an agreement with them to process that probably end of August or early in September.
Okay. So still moving just as you expected, basically.
Yeah, we've announced our contractor who'll be partnering to do the work out there, and they've been in the office. They're a local Sudbury contractor, a joint venture with Technica Mining and two local First Nations. A very credible, great group. We're so happy to work with them. But yeah, they've been in our office regularly over the last couple of weeks, working together with us, planning out the work and getting that all scheduled. So yeah, everything's on track from that end.
In terms of permitting and everything, locals and fishes and birds, everybody happy up there?
Yeah, well, I say that we have all our permitting. Is everyone always happy? I hope so. But yeah, because of the brownfield nature of Crane Hill, so it was a past producing mine operated for many decades under Inco ownership, and shut down in 2001, and then went into closure with buildings being removed, head frames and openings being capped in 2002, and it's been a closed mine since then. So what we've done is we have taken our closure plan, which is sort of the main document here in Ontario for mines, and we have amended that to go from a state of closure to a state of production, which allows us to move forward. But because there are already existing permits in place from when it was in production, then it just became amendments to those permits, and some of them are still in good standing. And so it really allowed us to move things very quickly, and again, with very, very minimal impact on the environment from what was already impacted. We have a small footprint doing things, on basically the same impacted ground.
Right. I saw that you recently got your dewater permit as well. Is that going to be a challenge? I suppose it's kind of a scary word, right? Dewatering, when you start thinking about it, sounds like a huge project. Sounds like it might be an issue or something like that. So how's that going, or how is that going to go?
Yeah, so our dewatering permit again was a great milestone for us. It's important, but the dewatering is really pretty straightforward. The mine over time gradually flooded, so now there's water within approximately 20 meters from surface, and our plan is to cut a hole in the cap in the shaft, lower down a pump and some piping and hoses, and start dewatering. Now we don't need to dewater the whole mine to get started. We will dewater as we are developing. We'll start this summer, give ourselves a couple 100 feet or 100 meters sort of ahead of us as a bit of a buffer as we drive our ramp from surface underground. But we're going to be processing this water through Vale's existing water treatment plant. So because this was an old Inco mine, which is now Vale, there is a water treatment plant that treats all the impacted water from these sites, and there's a number of mines that Vale has owned in this part of the Sudbury Basin. So that water all reports to their Monk Lake water treatment plant, and gets treated and then discharged. So all we're doing is adding in some additional water to that already permitted water treatment plant. So it is a fairly simple water permit to take water, and a fairly simple process.
Right. in terms of steps that have to be completed before, and I know it sounds like I'm moving quickly. It's going to make sense in a second because I'm just trying to set the stage before we can talk about some of the specifics. But in terms of steps that have to be completed before you start generating revenue here, what happens after dewatering the mine?
So again, we only need to start dewatering just in advance in anticipation of getting underground development started. So our first steps will be this surface bulk sample that we'll be sending out from our 109 footwall zone. That'll be processed, as I said, through Glencore's Strathcona mill, and we'll receive some revenues from that. That'll be, that will produce a concentrate. The concentrate will go to Glencore smelter here in Sudbury, and we'll get revenues from that some months later. So that'll be sort of first revenues. But again, this is for advanced exploration, and our test mining. Once we start our development later this year, our ramp development will go underground. Our first level will be somewhere around the 30-meter level below surface, approximately 100 feet below surface. We'll be cutting into the ore and start developing some platforms to better understand the continuity, specifically in our 109 footwall zone, where we're taking our surface bulk sample from, but testing it at depth deeper in some areas that now we believe, a good understanding. But until you actually go down, you mine it, and you can reconcile against that block model, it's still a calculation based on drill holes and best practices. But then we'll continue with our ramp down deeper. We'll probably cut in a couple more levels into the 109 in preparation for some test stoping as we continue to drive our ramp further to the west and access areas of the intermediate ore body, which is a nickel copper contact ore body, as well as the 101 footwall zone. And that was an area that is very interesting. It is a very nickel rich footwall area with sharp walled veins. We've drilled some spectacular holes there within 100 meters of surface, and we will be going in and again accessing that part of the deposit, putting some drifts in place, silling out along the contact of some of these sharp-walled, very high-grade nickel veins, and setting up for some test mining in those areas. So as we're doing this, initial development in ore, we'll be starting to ship ore to Vale's Clarabelle mill. So we have two agreements, one with Vale, one with Glencore. And again, there's a period of time from the time you ship it to them and they process it, and then to get paid, there's a number of months there. But that'll really be our first revenues, and it'll start off a bit in batches almost as we are developing more waste than ore. But over time, when we open up more areas, it'll become more consistent. And that's really what our test mining will do. And that's going to take us, call it 12 to 18 months. And that's going to give us a lot of really good information to make that decision now. Do we just continue mining? What detailed engineering we need to make a commercial production decision? It'll feed into updated technical reports, pre-feasibility/feasibility studies. So there's a lot of really good information and de-risking we can do as we are generating first revenues.
When does that first revenue start coming in? You mentioned a couple of times it's a couple of months in between, 12 to 18 months. Are you thinking first revenues in 2026? Does that make sense?
Well, the mineralized rock will be test mining on surface because it's not technically ore because we haven't put it in a feasibility study or a pre-feas. But the test mining we will do on surface in the 109 footwall that will be processed through Glencore, we'll receive first revenues from that 20,000 ton sample in Q1 of 2025. So, approximately 5 months, 6 months after mining it. So, then going forward into 2025, we'll have a similar type arrangement 3 to 6 months after we ship any of these test mining product to the mills. We'll get revenues from it.
I don't assume it's going to be anything huge. Again, based on how much work you have to do, I don't assume it's going to pay for too much, but what is it going to pay for that revenue?
Well, it will be reinvested into our project. So again, continue to develop and explore, do the test mining, some underground drilling. So all the typical things we'll need to de-risk the project. That's where those revenues will be used.
Okay. Are you guiding any amounts as to 2025 revenues, X 2026 revenues? Why, or is that too early?
Yeah, it's it's too early. We're still developing those numbers. Now, our plan is to update a resource for Crane Hill in Q3. So we've done about over 23,000 meters of drilling to date since we've acquired the property, and that are not included in our current mineral resource estimate. So, and a lot of this drilling has been in our footwall zones, which we see as, a great opportunity to get a better understanding of and potentially expand and define much better. And so that's where a lot of the drilling is. It's a really interesting area. So that will get incorporated into this new mineral resource estimate, which will feed into an updated PEA for the project. And with that updated PEA, we'll be able to give guidance on what advanced exploration will look like, as well as what does a life of mine plan, what's the potential of that.
Okay, so bulk test sampling by the end of Q2, which is very soon, updated MRE by the end of Q3, very first revenues Q1 of 2025, and then PEA is to follow thereafter. Am I following?
The PEA we'll put out probably in Q4 before the end of the year.
Okay.
So it'll basically be right in conjunction with our updated resource, and we'll be working on that as we're working on our initial advanced exploration plan, like finalizing that, and then looking at how that could play into a commercial production in the future.
So it's going to be a capital intensive rest of 2024 right now. How much money are you budgeting for the rest of the year?
Yeah, so the surface work and the surface ball sample is actually not very capital intensive at all. We'll be funding that with cash in our treasury, and we haven't put out official sort of guidance on what that is, but it'll be in the order of hundreds of thousands of dollars. So not a huge amount of cash, very simple, come in already road access brownfield site in Sudbury, set up some drills and drill and blast, crush some rock and ship it off site. Very simple. Now the ramp in the underground development in our PEA from last year that we put out in July of 2023, we guided advanced exploration costs of being $48 million. Now, when we look at what it'll look like now, we are not doing the surface open pit mining in our current iteration. We're looking at higher cutoff grades, looking at mining and shipping higher grade portions of the deposit, which has better margins, better payback. And now that we have definitive terms from Vale, we can put some real good estimates on the economics of that around it. So that's what we're looking at doing. I guess what that means is, what I'm trying to say is the $48 million for ADEX, we think is too high, because it incorporates, moving a lot of waste rock and getting things ready for surface mining in our current PEA. And our new PEA, it will not have that surface mining. So we expect that CapEx number to come down. And again, because there will be revenues coming in, and more revenues than was in the previous PEA, some of that capital costs should be offset by near-term revenues and focusing on higher grade portions of the deposit that aren't in the current resource. Therefore, we're not in the PEA we put out last year. So there's going to be quite a few differences. And at this time, what we're planning on doing is funding the advanced exploration primarily through what we're looking at doing and is ongoing at this time, a royalty or stream on precious metal byproducts, which make up, a significant portion of the overall economics. Combined platinum, palladium, gold, and cobalt, which we consider all those are, significant byproducts, make up about 18 to 20% of the revenue breakdown. So, for example, streaming or having a royalty on gold only, doesn't have a significant impact on the overall economics of the project, but could bring in a significant amount of cash to help fund the ADEX. So that's something we're exploring right now.
How much money do you have in treasury right now, by the way?
So as of last financial statements, we had about $8 million in cash, and some of that is HST that's coming back in that we consider cash in the bank, but we're just waiting to collect. But yeah, we're well funded for the exploration we have going on right now, and all of our plans outside of the underground advanced exploration.
Yeah. Yeah, as I mentioned at the beginning, I believe the current assets was something along the lines of 9 million. Actually, it was 7.5, I believe, cash, and then some receivables on top of that. But I mean, you're not at liberty to tell me what there is in the bank right now after the work that's happening between, or
Yeah, I can't say, it's not publicly disclosed,
sure.
so we can't go and say exactly where we are. But of course, we have a burn rate that, as we're continuing to advance, we have 3 drills turning. So we're spending money on exploration, we're spending money on, other G&A as well as engineering. So there is, money being spent right now, but we have a good handle on our budget for this year.
Where I'm going with this thing and why I'd like to know specifically is because I'm trying to understand when do you go out and raise and what is a good time for you to go out and raise, because we're going into the slower summer months, if you will. Doesn't look like the nickel and the copper price are working with you, although your stock seems to be holding up nicely and it's up quite a lot since the beginning of the year too. So yeah, when's the right time to go and raise money?
Yeah, so there's 2 ways, I guess, and 2 reasons why we would go out and raise money. And as I mentioned, for Advanced X, we're looking at a comprehensive package right now, looking at royalties and streaming. We're also looking at, how do we supplement that, whether it is with a portion of equity alongside that. Does that come in after a royalty and stream? Does that come in after we actually start breaking ground? We're also looking at how much the potential revenue may be from the 20,000 ton surface bulk sample, when that'll be coming into our overall budget that can be reinvested into the Crane Hill project. So we're not in a rush to get anything done. We think it's going to be also very important to get our new mineral resource estimate out into the public. It's also going to, I think, guide sort of the higher grades that we're looking at mining, and I think it allows to get us the best cost of capital, whether it is on royalties and streams and or a potential equity raise towards the end of the year.
And that's exactly where I was going. Potential raise towards the end of the year. So it's not something you're thinking of doing in the summer months, Q3.
No,
Okay.
we in 2022 we acquired Lonman Canada, which owns the Crane Hill project. And I remember, as part of that acquisition, we had to announce a financing shortly after announcing that deal and to fund that acquisition. And we did that in August. And it's never fun to raise money in the summer. The only reason we would ever look at, raising money outside of sort of, in the fall would be something around, an acquisition. So it is something that, we do not need to do right now.
I do want to touch upon potential acquisitions because you've teased that in a couple of interviews, but we'll save that for the latter part of the interview. And specifically because we've been talking about all these X's, we're talking about CapEx and AdX and hopefully not my X because we're going to piss off my wife. But let's talk about OpEx from the economic studies that you have right now on both projects, really. Is that realistic for the current environment, inflation and everything account? And how do you think OpEx is going to look like?
Yeah, that's a great question. And it's so critically important for how, mines are being operated. And, to do a PEA technical study on a project that has, inferred and indicated resources, but it's still at the very early stages is quite risky. And, anybody who's been around the mining industry before is often, very optimistic and underestimated. In our case, now that we have contract miner who's going to do the initial work, we have terms, so we understand what those costs are going to be. And that helps guide the cutoff grades that we're going to use when we start looking at designing our test mining stopes, as well as our life of mine stopes. At this time, our plan is to use a contractor for all of the AdX work. And we're very pleased with that. Longer term, we would definitely look at bringing in our own owner-operated equipment and take that in-house, perhaps use contractors for the capital development underground, but for production using our own people, which does have some cost savings. You put some capital up front for equipment, but you have cost savings on labor and management. So I guess long and short of it is we believe that, we have a very good handle on the operating costs that we have. Now our PEA was based on large tonnage. We were mining underground, upwards of 3,000 tons a day. And with that scale, you have certain, benefits and economies of scale in the production. Now what we're looking at doing now is a little more selective. It will be, as I mentioned, using a higher cutoff grade, focusing on mining higher grade stopes first, not necessarily and definitely not, going in and picking the eyes out of the pie, so to speak. But we are going to be just looking at opportunities. Where can we develop to the higher grade stopes, while we also develop past secondary stopes that are slightly lower grade, but once the capital development's in place, we can go back and mine those stopes without actually, jeopardizing sort of longevity of the project, but at lower tonnage rates. And what we're thinking right now, and this will come out once we have our resource out and we update our PEA, is probably something more in the range of 1,500 to 2,000 tons per day. So with that, lower production rate, your operating costs are going to be a bit higher than they would be if you were 3,000 or 4,000 tons a day. But again, we have a really good handle on that because we have quotes and we're ready to get started, and we know who the contractor is going to be, what equipment they're going to be using, what size all the development's going to be. So we have a good handle on it.
What would that look like more specifically? Like, can you give me a number or a ballpark number of what you're thinking?
Yeah, so right now we're looking at about $125, per ton when we are producing, using a contractor, and on top of that, there'll be processing costs from a third-party mill. So that gives, an idea, a sense. And then we also have a per cost meter, which I can't disclose for confidentiality reasons with the contractor. But there is, a very fixed per meter cost for development. And we're looking at a 4.5 meter by 4.5 meter development underground.
Right. Okay. Yeah, I like that. I like the detailed breakdown of the cost here, and I understand I might be pushing you a little bit too much for. And I understand you're probably thinking about compliance all the time when you're speaking with me, and that's probably challenging too. But it all sounds, again, as I said at the beginning, simple but not easy. So, but still simple. I mean, you're telling the story also with ease, and it's making me think, like, why didn't anybody think of doing this with the brownfield assets in that region before you did? Like, why aren't these projects already operating in a hub and spoke model? And why is the region not swarming with little $10-20 million juniors trying to copy your strategy here?
Yeah, well, that's a great question, and we could talk about this for an hour. So
I've got an hour.
So we did it. We did it before, and I say we because I was part of the team. So Sudbury has been dominated really by two companies for the last 125 years. Originally, it was Inco and Mond Nickel, which was their predecessor, but Inco and then Falconbridge. And now Inco was acquired by Vale. Falconbridge became Xstrata and then Glencore. And these are, two of the biggest companies in the world, mining companies in the world. And so with that, they had all the land tied up, everything. And they really, they didn't talk a lot about it, about exploration discovery. They had a long-term plan where they had a 20-year, plan for the basin, what projects they were going to develop, where their ore was going to come from. And there wasn't really any room for a junior until FNX Mining. And FNX Mining was founded by a person named Terry McGibbon, or he was led by Terry McGibbon. And Terry was the past VP of exploration for Inco. Retired, became the CEO of a junior mining company, and saw this opportunity where there was a number of past producing Inco mines. They were shut down, brownfield, much like Crane Hill, that, from an exploration point of view, he still knew there was potential there, but knew it had to be in the hands of a much more nimble management team that can make decisions quickly and move these projects forward. So, with that, he was able over a period of years to negotiate the acquisition of 5 past producing brownfield mines back in 2002. And I joined the team in early 2005. We were able to bring 3 of those past producing mines back into production, made some new discoveries, expanded on existing resources, became very profitable. had a lot of cash, reinvested that cash back into, more development, and we were bootstrapping our way to becoming a serious mining company. And we ended up merging with Quadra to become Quadra FNX, and then Quadra FNX was acquired by KGHM, another very large copper company out of Poland. And so now, aside from Magna, there's three majors. There's Vale, Glencore, and KGHM in the Sudbury camp, and Magna. So yeah, how come it's a really hard jurisdiction to get into because of the majors that are here, and because there's really very little opportunity to pick up these kinds of assets. Now, I've lived in Sudbury for 24 years. I've worked for Inco. I worked for FNX Mining. And that's really what inspired me when I saw the acquisition of Quadra FNX by KGHM. It made me think, it's come full circle. These assets that were, became a multi-billion-dollar company at one time within FNX are now back in the hands of a major, which maybe they don't make sense to. Maybe, they're not material to. And that's what kind of inspired me back in, even in 2015, a year before I founded Magna, to start looking at opportunities in Sudbury. And the first one I saw in 2016 was Shakespeare Mine. So that is really what spurred me to found Magna back in 2016. We closed the acquisition of Ursa Major Minerals, which owned Shakespeare, in 2017. And that, I thought, was a very strategic asset because of the permits in place already to build a mill. And that was something, there is only two mills in Sudbury, one owned by Glencore, one owned by Vale, which we have agreements now with both of those mills to sell them more and process our material through it. But then what's our next acquisition? And it took us, again, a number of years to acquire the Lonmin Canada, which owns the Crean Hill mine. And we closed that again in 2022. And, we see other opportunities in Sudbury, much like Crean Hill, non-core assets owned by majors that have potential to be long life operations, maybe not at the scale that the major companies need to really move the needle for them, but for a junior company, can be flagship assets and create a tremendous amount of cash flow that can be reinvested. So this is the opportunity that we see. We have a very strong foothold. It's taken me many, many years of being in Sudbury and living and breathing it, and building relationships and building a reputation here to be able to get, make progress on acquisitions like Lonmin Canada and Crean Hill. So yeah, that's the long and short answer of it. Is it takes a lot of work. It's really hard. It's a proven business model that has been very successful in the past. I think we're adding in some new opportunities with having the ability to build our own mill in the future at Shakespeare, but also being able to leverage off the existing mills, the existing infrastructure, and having a relatively low capex startup by selling ore to start generating profits on brownfield site that we bought with many permits already in place.
The barrier to entry was also kind of my first thing when I started thinking about this and thinking about what's open to who. Because if I tried to make an entry into Sudbury, I wouldn't even know how to start. And I assume I'm not the only one. And one other thing, though, that I started thinking about was the model itself. So the hub and spoke model. Hub and spoke models typically rely on ore blending unless it's the same exact asset, which in your case, I assume because of the great discrepancy between the two assets, that would be the case for you as well. Then I suppose the twofold questions: am I assuming wrong? And if I'm not, how are you going to deal with the ore blending here? And do you think that's going to be a challenge?
Yeah, so there's a few different styles of mineralization, the styles of deposits in the Sudbury Basin. They all have the same a lot of the same minerals. They have a lot of the same metals, so it's almost everything has some amount of nickel, copper, precious metals, cobalt. And, in Sudbury, there are some deposits that are, I'd say, respond better to the traditional flotation methods that you have here at both the mills. And these types of deposits have seen less attention over the years and have been less important to the major mining companies. And that's the opportunity to have a third mill and a third processing plant. But all that being said, our Shakespeare deposit, it was a past producer, produced 500,000 tons from an open pit went through the Strathcona mill, had very good recoveries. extremely good recoveries for the, the grade when you're talking 0.33 nickel and 0.35 copper and about, 0.8 grams platinum, palladium plus gold. Not super high grade, but when it's right on surface, low stripping ratio, low mining costs, and you have good recoveries, it can work very well. As a toll milling operation where you're paying higher processing costs, it makes it much more challenging. But if you had a mill right next to that open pit, as our feasibility study demonstrated, you can make a lot of money on it. The challenge with Shakespeare was it was just not a long enough mine life. The deposit at 4,500 tons a day only had about a 7-year mine life. So, it started making really good money in years 3, 4, 5, 6, 7. But, for an investment, you want to see at least, a 10-year mine life or, 5, 6, 7, 8 years of production after payback. So by combining it with a project like Crane Hill, where you have perhaps, and these are just numbers I'm putting out there, 2,000 tons a day coming from underground at higher grades, trucked out to Shakespeare, which is about roughly 45 kilometers, 50 kilometers from the Crane Hill project to where the mill site would be. And then blending that with perhaps 2,500 tons a day from an open pit where you have flexibility. If you need to do a little bit more open pit mining, it's right next door. You can add in a little bit more open pit if there's a little bit less underground, or vice versa. If you get a little more underground, you can hold back on it. But similar processes. The one thing we could add in is potentially a gravity circuit, which improves precious metal recoveries. And that's been shown, although currently neither of the mills in Sudbury are using it, but there is a lot of precious metals. And we believe, based on some test work, that more of those precious metals can be recovered in a gravity circuit. And you can also fine tune it in a 4,500 ton per day mine or a mill. When we're sending in, let's say, just 2 ore types, you can fine tune that to getting the, specific grind size you need to, and the specific retention time in the flotation tanks to optimize that recovery and produce, the best saleable concentrate. So there's a bunch of benefits, but metallurgically, we only see upside in it. We don't see challenges in blending it together. And especially if there's only, let's say, 2 deposits being processed, that's very straightforward. If we had 5, well, then it becomes a little bit more complex, but still very manageable.
Is all this that you're telling me here, and thank you again for the in-depth overview, is that gonna depend on what's coming out of the footwall now at this new zone 109 that you mentioned? In terms of why I'm really bringing this up is because I'm thinking grade and thickness variability, because, and I understand some of these questions might sound silly, but given the polymetallic nature of the mineralization here, I'm trying to better understand how all that is going to work in a mining scenario, specifically because with your latest news release from the 109 zone, there was quite the great variability, sometimes from over 6.5% nickel equivalent all the way down to at times 0.5% nickel equivalent, with thickness also varying here and there. And so how do you account for this variability, and what does it mean for the overall situation here, for the overall production?
Yeah, and that's a great question. And it's one of the reasons why we think this test mining and advanced exploration is really important to better provide information so we can make better decisions going forward. The 109 footwall zone, what we've seen from our drilling and how we are modeling it, there is a higher grade sulfide core to it that can range from 0.5 meter thick to, up to some places 5 or 6 meters true thickness. And that higher sulfide core is where we're seeing, as you mentioned, nickel equivalents up to sort of 6%, where you have higher PGMs and, lots of copper and nickel. But outside of that narrow zone, there is lower sulfide, high PGM styles of mineralization within this breccia matrix. And that overall zone, if you kind of take it hanging wall to footwall in this footwall zone, or east to west, it could range from 15 to 20 meters wide. But as you get further to the extremes out from the core of that, it becomes lower and lower sulfide, and typically higher tenor in PGMs. So where you could have 0.1 nickel, 0.2 copper, but 15 or 17 grams of platinum, palladium, gold when you get to those extreme edges of this zone. So understanding how can we recover more of that low sulfide PGMs, and that will dictate how wide our stopes are underground. It'll dictate, what our cutoff grades should be. It gives us a lot more information, and that's information we can use to better plan what a future hub and spoke production model and how we design our mill at Shakespeare, how much of that material you'd want to be blending in, you know, how well does gravity respond. So all of this test work we're doing right now and this test mining is going to help educate us on that. Now, our surface bulk sample that we'll be doing, we're going to be processing, you know, both sort of the higher grade core as well as this peripheral high PGM, low sulfide styles of mineralization. It's going to be, you know, really how does this look if we were to process all of this in a big area, similar to how you could do an underground 20,000 ton long hole stope. But as we're blending it through, we'll be able to do test work and understand sort of what that right balance is and how can we optimize recoveries in either a third party mill or in our future mill at Shakespeare.
Jason, I understand that you have to run in about 5 minutes, so it's going to look like I'm jumping through these topics, but you mentioned some of the current work that's happening, and you're also drilling right now. There's 25,000 meters. Most of it is focused on the footwall. There's some drilling happening at Shakespeare. How's that going? When are we going to get some news on that?
Yeah, it's going really, really well. It's pretty exciting. It's an exciting part of our business strategy. And so there's 2 drills turning out at Crane Hill right now. One is drilling on the 109 footwall to try and extend that deposit below the 1,000 foot level, which is really where the resource is defined to. And even within that, between 750 and the 1,000 foot level, there's limited drilling. So we want to add in some more holes there. Those results should be out, I would imagine, in early July. In our deep footwall drilling, we're drilling some platform holes. These are deep 1,400 meter deep holes and then far back into the footwall, where we believe there's really good potential for a new high-grade footwall discovery. Similar grades to the core of what we're seeing in the 109, where we're seeing, you know, lots of copper, you know, some decent nickel, but also a lot of precious metals. That's kind of what the typical footwall material looks like. Other footwall deposits in the basin that we're modeling, you know, as analogies to what we're trying to discover would be like the 126 ore body at Valley's Creighton mine, which is sort of 9% copper, 4% nickel, and 15 grams of platinum, palladium plus gold. That's the kind of, you know, tenors and grades and ratios of metals you often see in these footwall zones. So we're on our 6th hole right now, our 6th platform hole. Each hole we're doing borehole geophysics, both EM and gravity, and that is giving us a lot of good information. We've seen a lot of anomalies to follow up our drilling on. You know, we're triangulating in on the area where we're seeing most of these anomalies. So that work's ongoing. It's pretty exciting. And it is true exploration. There's never been a hole drilled back in these areas, you know, 350 meters, 400 meters back into the footwall. So pretty exciting stuff. And much like the work, you know, many of my colleagues here at Magna did while at FNX and discovered a number of footwall deposits there. So using all that experience in what we're doing out there. And then at Shakespeare, our drilling out there is really, it's exciting too. It's the accumulation of, you know, a couple of years of work now at Shakespeare. We've done a number of geophysical studies. We have taken all of this data, geophysical, better interpretation of the geology, to kind of narrow down to 4 or 5 target areas that we think have potential to create some real value through the discovery of a new economic deposit. So we're not looking to just test showings and just kind of do grassroots, you know, boots on the ground geology. We're taking all of that we've already done and now drill testing 4 or 5 targets. So we're on our 2nd target right now, and waiting on results back from some of the earlier work we did in April and May. But so far so good, really exciting. And you know, it's exploration out there. So the stuff we're looking for is really new, but it's got all the right ingredients. So we're seeing geophysical anomalies. We're seeing the right rock types. We're seeing in many cases, you know, the right type of nickel copper mineralization on surface already. So it gives us a lot of hope when you see, you know, multiple types of geophysics showing anomalies at depth. It gives us confidence that there's at least the potential to have an economic new discovery out there. So that we have about 5,000 or 6,000 meters of drilling budgeted out there. We're about almost halfway through that. So yeah, it's going well.
So busy times for you ahead, sir. You have as you said, so over the next 2 weeks, you're going to have that sample announced and how that's going or how that went. And then you're going to have, by the end of Q3, you're going to have the MRE. By the end of Q4, you're going to have the PEA. In the meantime, you have all these results coming out from this 25,000 meters of drilling. And then one last thing that we didn't talk about that we should be talking about is that, you'd be looking to buy another non-core asset. I believe you said within 12 months. A couple of months ago, I watched the presentation. I like the specific timeline, but what kind of an asset are you looking for here? What makes you, and I mean, that timeline is very specific. What makes you confident in that timeline, and what kind of an asset are we looking for?
Well, and I guess to qualify that, this is our hope. It's what we want to do. We are in discussions with all three majors that are here in Sudbury. We know them very well. We have 2 agreements with one. The other one is we know their assets very well, and we have regular dialogue. They're building a mine right next to Crane Hill. KGHM's sinking a shaft at their Victoria project, so they're our neighbors. So we talk to all the majors all the time. We do have our eye on a couple different projects that sort of meet the criteria we're looking for, and it's a lot like Crane Hill. Past producers that have advanced permitting, that have existing resources, where we see potential for a company like Magna to be able to move that very quickly towards production, where we think there's still exploration potential that may have been overlooked, and could fit in potentially to a future hub and spoke production model. So we're not looking to do early stage exploration. We're really looking to find something that could be that next spoke in a hub and spoke production model, and something that could move very quickly into production.
But the end goal remains unchanged. Like you want to build the next nickel mining company in Sudbury. You're not building a takeover target here. You actually want to get into production.
Yeah, absolutely. And then, I try never to say that we're going to become, just the next nickel company. We will be producing nickel, but we're producing a lot of copper. That's going to be significant. And we're producing a lot of precious metals. So we're not just a nickel story. And I think sometimes Sudbury gets painted with the brush. It's just a nickel camp. Overall in the camp, it's a 1-to-1, nickel to copper. So a lot of exposure to copper here. And, one thing that I want to remind people is that, I talked about the FNX story. FNX merged with Quadra, and KGHM bought Quadra FNX for copper, not for nickel. And actually in Sudbury, we weren't focusing on any nickel ore bodies at that time. It was all mining high grade copper footwall deposits. So there's a lot of copper in Sudbury, but yeah, we want to be a mining company. I think we can become Canada's next great base metal mining company. I have a 10-year vision of where we can take this company. Over the next 10 years, I think there's tremendous growth in Sudbury. I think Sudbury is ripe for a company like Magna to come in and help fill these mills that are here in Sudbury, being more entrepreneurial, being more creative, and having a lower cost structure just by being a more nimble company. So there's a great opportunity here. We're going to take it one step at a time, like I've always said since I founded the company. This is our strategy. You don't build great companies overnight. We're doing it one thing at a time. Our next step will be getting our advanced exploration and our first revenues from Crane Hill, and then we'll just keep building on that.
Good. Well, thank you, Jason. I've already not been respectful of your time. I've got a couple more questions, but I'll not do it right now. It seems like you have a lot going on, and that you're going to have a lot of news releases in the near future. So let's follow up on some of those in a couple of months' time, and you can tell me more about it. I know you have to go. I'll just let you drop off now, and I'll move over to the second CEO barbecue for today, for which I'm going to have to travel down to the US. But we're going to stay focused on nickel because I'm looking at one of the very few high-grade nickel deposits in the US. And I'm going to be hearing about it from Sean, Brian, and Todd, who are here to talk to me about Talon Metals. The company is listed as TLO on the TSX, so no V's, the TSX main board in Canada, where an average of about 200,000 shares trade each day, with a 52-week high of 35 cents and a 52-week low of 12 cents, with a market cap of about $135 million and about 935 million shares outstanding. Today, this is a 15-cent stock. There are no warrants, but there are 120 million options outstanding at an average price of 18 cents, bringing the total number of fully diluted shares to 1,055,000,000 fully diluted shares. About half of the company is in the hands of 5 major groups, if you will. So Rio Tinto's in there. Rio Tinto holds about 6% of the company. Management holds about 3.5%. The Rio Tinto connection is going to make more sense, by the way, here in a second. But looking at the latest balance sheet, which is dated March 31st, the company had about $16 million in current assets, 4.5 of which in actual cash, 8.5 in treasury bills, and $2.5 million worth of prepaid expenses. I'm rounding up and down here and there, but you can see it on your screen right now. No major long-term debt, but there is some debt. There's short-term debt. There's about $3.2 million of account payables and accrued liabilities. Same financial statement, which is from March, again, also tells me that on average, over the last reported 3 months, Talon recorded about $210,000 a month on administrative expenses, whereas over the same 3-month period, a total of $7.2 million was spent on the company's properties. So that's good for about $2.5 million a month in project expenses. This means that administrative expenses represented less than 10% of the total spend, which is notable. And the majority of the spend was focused on the Tamarack project, which I'll be telling you more about in a minute. But as always, I'm going to need you to understand that this is nothing more but a snapshot in time. In this case, it is specifically at the end of March of 2024. And the finances are likely to have changed by the time you're watching this. So please head over to the company's website as well as setterplus.ca to look at all the numbers yourself to make sure that you're getting the full picture. Accounting is, of course, a whole lot of fun. We can have fun with it for days, but fun is not the only reason why we're here. We're here to talk about nickel, and talk about nickel we shall do, specifically because Talon has a lot of it at their Tamarack project, which is in Minnesota, the project was creatively named after the city of Tamarack. It's a little unknown city, not many people, but it's a city. It's in east central Minnesota. That's in the northern United States, of course. Talon currently owns 51% of the Tamarack nickel project with Rio Tinto. I told you that's going to make sense, but Rio Tinto owns the rest of it, so 49% is what Rio Tinto owns. Talon has, though, the option to earn up to a 60% interest in the deposit if they complete a feasibility study and pay Rio Tinto $10 million by 2026, and that's US, 10 million US. There is an MRE on it. A 2022 MRE on this project already showed 8.5 million tons of 2.34% nickel, so a little under 2.5% nickel equivalent in the indicated category. And there's 8.5 million tons of 1.2% nickel equivalent in the inferred category. And this is making it one of the, if not even the only significant high-grade undeveloped nickel deposit in the US, and therefore also making it interesting and potentially important for the U.S. government as well, which, by the way, the U.S. government granted Talon $20.6 million last fall for the domestic discovery and exploration of nickel projects, which this $20.6 million grant basically doubles the company's exploration budget for 2024. So apparently it's a big deal. Talon has also kept drilling since the resource estimate that I told you about, though. They hit one of the best nickel holes in all of 2023, kind of spectacular here. Those over 100 meters of 3% nickel equivalent. And then most recently, they discovered a new mineralized zone close to the resource zone, but again, outside of it, with highlight grades being up to almost 5%. Yeah, so it's almost 5 meters. So it's not a huge intercept, but it's almost 5 meters of almost 5% nickel, 4% copper, some cobalt, as well as PGEs in there. And there's almost 80 meters of 0.8% of nickel in the same hole. Those drill holes will now also be used for borehole geophysics, by the way, to help Talon come up with new targets, which will then be part of the 2024 drill program, which includes, by the way, that 2024 drill program includes 30,000 meters of drilling across their 2 projects. And they're going to be using their drill rigs. They own their own drill rigs. I believe it's 3 or 4 drill rigs that they own. And so all in all, what has been discovered today and what is potentially, again, forward-looking, but potentially going to be discovered in the future, that's not in the resource. But what's been discovered to date, that brings the total strike length of the mineralization here up to 18 kilometers, a lot of which, again, not including the current resource. Who else is interested in this nickel is Tesla, by the way. About 2.5 years ago now, Talon entered into an agreement with Tesla for the purchase of the nickel concentrate that is expected to come out of this project eventually, potentially forward-looking again, where Tesla has committed to buy about 165 million pounds of nickel in concentrate. And that's in total over a period of 6 years. But that's also contingent on Talon earning in that 60% interest that I told you about with the 10 million from that they have to pay to Rio. And it's also under the condition that commercial production is reached by January 1 of 2026. So call it 18 months from now, which is rather aggressive, but I'll ask about that later on. Tamarack is not the only thing that Talon's got. They're also active as we speak. Actually, they're on the ground in Michigan, where they're looking to form drill targets, and they're aimed at looking for something similar to the operating Eagle nickel mine in Michigan. And drilling is expected this summer there, but hopefully, again, an update on that later on in the conversation. As I'm saying this, gentlemen, I'm thinking maybe it's a good point for me to start shutting up, because all of this sounds very positive, as company material often does, but and you have some great marketing material. Granted, you were in the Wall Street Journal and whatnot, and you have a lot of stuff explaining how it all works too. But then at the same time, I open up the stock chart, and it's pretty much the opposite. It's pretty much a straight line down for the last 3 years. Goes from upper left to lower right. What's happening? What's the market not liking about this? What do you do about it?
And look, it's a great question, because, I would say from a management standpoint, we are continuing to deliver. I'm sure Todd will have some views on this as well, but, my view is that a lot of it has to do with the stage in Minnesota that we're at right now, announcing that we've gone into permitting. At that phase, I've dealt with some shareholders that have reached out to me in terms of, I guess, some general skepticism just related to permitting in the U.S., which I think affects many U.S. projects. In addition to that, look, nickel has been a challenging place over the last while. You have a significant amount of nickel that's been coming in from Indonesia, and I hear from investors all the time about their fear of what that's going to do to the nickel price long term and to projects. The comment I make to a lot of investors as it relates to that is that that is the magic of having a high grade deposit like Tamarack, and why everyone always talks about how grade is king. I mean, if you look globally at the moment, I would say the two projects that investors should be looking at as a comparable is you've got Eagle in Michigan, which is a high-grade project that's currently in production, and you've got a project called Nova Bollinger, which is in Australia, that's owned by Independence Group, another high-grade deposit, similar attributes to Tamarack. And if you look at their financials, if you look at their economics, if you look at how they've fared in difficult times for the price of nickel, you can see that they do excellent because where they sit on the cost curve is in the lowest quartile, which is ultimately where Tamarack is headed. I think that one of the challenges we have as a company at the moment is that you had mentioned earlier that we've got a resource report that's out, but we haven't yet put out economics. So some shareholders are waiting to see what that's going to look like before we can convince them in terms of where we're going to be on the cost curve and that the project is going to be economic in any environment. I mean, again, those are just some of the things that I think we're dealing with from a share price standpoint. Todd, maybe you can add to that.
Yeah, I mean, I'm not a market technician, Antonio. So, I may not understand all the dynamics in terms of when the stock went up after we announced or made our Tesla announcement, and then sort of traded down after that, which I think is a market dynamic observation. I'm not a day trader. I'm a long-term buyer of the stock myself. So to me, it's just the market maybe has an overly pessimistic view of Indonesian nickel, Chinese nickel coming onto the market, and a lack of understanding, quite frankly, of how the IRA will work within the North American EV battery manufacturing supply chain. If you look at the current production of batteries, those that are under construction, and then those that are announced, 95% of those manufacturing facilities in North America are in nickel-based battery chemistry. So the embedded manufacturing capability for EV batteries in North America is long nickel. The IRA, when you consider that, is basically saying you can only have minerals sourced from certain countries, eligible countries. So that means pretty much in nickel, Australia, Canada, the United States. So I think as people start to understand some of that dynamic, hopefully they'll appreciate what a special asset we have in the right place, sort of right place, right time. And then I think also, you know, we're in a boring part of the Lausanne curve where we're in permitting. And so that is a place where people, maybe some investors, think that's sort of a black box, and they're watching and waiting. And what I hope we can get into today is a little bit of what we're doing on the permitting pathway, and how we're de-risking that permitting pathway, and how we have a strategy to be able to get it to market on schedule.
For sure, I do want to. Right, and we're gonna. I definitely want to talk about that as we move forward. We're going to talk about all these things, but there's just before that, go back to the dropping share price. One thing that I could think of or see that kind of, I suppose, could shock some people is the number of the shares outstanding. Which, while I do understand that, again, you have a couple of rather large shareholders that hold the majority of the company. And so you could say it's a decent share structure. The sheer number of over 1 billion fully diluted shares looks scary to on the first glance, right? Given how much of a chronic diluter our industry unfortunately has come to be. So any plans to roll it back on any type of catalyst anytime soon?
Immediate goal of doing a rollback. What we do, just as a matter of course, is every year when we hold our AGM, we go to investors and the shareholders, and we do get permission to potentially do up to a 10-for-1 rollback, but we haven't done it. We've had that right for a number of years. You know, I do hear from some shareholders about the number of shares that are out there. There's a whole historical reason for that. When we got involved in the company had existed for a number of years and already had a number of shares that were outstanding. So it's not specifically related to Tamarack and having raised capital for that project. I think the bottom line is, at some point, as you say, there will be the right time and place for it. But again, I don't think it's now. I think will be on some major milestone event where it makes sense to potentially do a rollback, but no immediate plans to.
Fair enough. That's also kind of how I prefer seeing it. Sometimes, you know, doing a rollback is really just the reason for the market to short you back down to a certain price that you were before. Why I'm asking this is, of course, just kind of keeping an eye on the dilution of where this is going. With the money you have in the bank right now and the government grant that's essentially doubling your exploration budget, are you going to have enough money to complete the entirety of 2024? Do you think you're going to have to raise money again this year?
So look, it depends on what I always call, if you keep your, you know, pedal to the metal. I mean, as Todd's going to talk about, you know, I would say the progress that we're making on the permitting front at the moment, you know, we're really excited about it. And, you know, for all intents and purposes, we'd like to keep the trajectory going. So we will need to, you know, shore up the treasury at some point. At the moment, I would say, you know, we're fine. We've currently got 10 million in cash, plus we've got another 7 million in receivables from the government for work that we've done that's part of the DOE grant that you mentioned, as well as the money from the Department of Defense. But look, as we progress, the way we think about it is, as we progress to the feasibility study late next year, we will have to shore up the cash a little bit.
Yeah, and that makes sense, of course. We'll talk about how you're going to get there, maybe towards the second part or the third part, or whatever, how many of our parts this conversation gets to be. Well, let's talk about what the more immediate future of what you're going to be doing with that money. And Brian, I suppose this is where you come in, is because I'd like to start with this the new discovery from earlier this year, the CGO East waterfall, a bit of a mouthful. But so it's a 40. It's a rather large step out from the historic high grades intercepted here. How similar is what you're drilling here to what's making up that resource of yours from a geology perspective, and specifically in terms of I'm thinking specifically about the type of rock, so lithology and now primary and secondary mineralogy here.
Yeah, so the CGO East discovery, we hit that a few years ago, 2021, and spent quite a bit of time drilling that up. One of the things that is a little different with Talon is we own our own drill rigs. So right before we made those discoveries, we decided to purchase our own rigs. We operate them in-house with our own drill crews. So we own 5 drill rigs. 4 are crewed, 1 is a spare, and that allows us the flexibility to chase things down pretty quickly. The other thing we've done was we paired that with in-house geophysics. With nickel exploration, you really need borehole EM because in nickel exploration, you don't have large alteration halos or any sort of geology clues that would point you towards or vector you towards mineralization. The geophysics is really what does that. So by bringing geophysics in-house, we can now drill a hole, survey a hole, and within 2 hours of completing the drill hole, we have an idea of where the anomaly is. That way we can pivot, assess the new target, drill it, and then keep doing that. So this new discovery, the CGO East waterfall, was one of those where we had a borehole EM anomaly. We had a rig that needed a hole to drill, and this is an area that I've always wanted to get back to. So we put them on that hole, and we drilled a really nice intercept, just over 4.5 meters of, 9.2% nickel equivalent. It's in the same rock, so Tamarack is hosted in a peridotite or a melagabbro. This massive sulfide, so the standard minerals, pentlandite, chalcopyrite, pyrrhotite, that's what all of our mineralization is. What's different about this intercept is it has a lot of PGEs. So at Tamarack, we don't have that many PGEs in the Tamarack ore body, a couple of grams. This has quite a bit. So some of the assays were up to, I think one of the assays was like 42 grams platinum plus palladium plus gold. That's a lot. And so that is different. That's fundamentally different at Tamarack than what other places we've seen. So that's sort of what we're looking into now, is why is it different? Is it a proto ore, or is it has it been fractionated? And put that story together, because when you look at the trend of the mineralization at Tamarack, everything dips at about that 15 to 18 degree slope to the south. This area, the CGO East waterfall, deviates from that orientation, and it starts trending straight down like a waterfall. We have a similar one of these on the CGO West side, where you have thin massive sulfides up to the north, they trend to the south, and then they turn into a large, thick waterfall. And that was kind of the kickoff discovery for us of CGO West, is we had these small historic 1.3 meter intercepts of massive sulfide. We did our borehole geophysics in an existing drill hole. We then drilled up that borehole EM anomaly that we got from that hole, and it went from 1.3 meters to 14 meters thick of massive sulfides. So that's kind of what we're chasing up, is now we have a new orientation, we have new mineralization, we have PGEs, a lot of them. Now we need to start putting together the plan and figure out where is this going.
The fact that there's that much PGE, or the rather high content of PGEs, are there any major or new metallurgical implications to that, or is that something you still have to figure out? How do you look at the metallurgy now?
Metallurgy is pretty straightforward at Tamarack. Tamarack is blessed with being coarse grained. So from a metallurgical standpoint, it's very simple to separate out your nickel from everything else. So that I met is one of the things that everyone has to do the work on, but we're in a pretty good spot with metallurgy at Tamarack.
But essentially the two zones are similar. How do they get formed? They got formed in the same way, essentially have similar structural controls, or how does that work?
Yeah, so nickel deposits in North America, we're focused in the Mid-Continent Rift. So 1.1 billion years ago, there was a rift that was ripping apart the U.S. It started pretty much under Lake Superior, goes down to Kansas. And when that happens, it's basically you have the continent, all the, like, think Pangea, all the plates come together and it heats up the mantle. And it sends up a mantle plume, which allows primitive magmas to come up to surface. These primitive magmas have a lot of nickel in them because they're very hot. So the nickel hasn't been stripped out into olivine and other minerals yet. That's the critical aspect when you're looking for nickel deposits. That's what you want to look for, these areas where the primitive magmas have come up. And it's quite rare to see these. And so what we're exploring is the plumbing system of an ancient volcano. We're looking to see in that plumbing system, where has that nickel sulfide, which is a liquid, while the magma is a liquid, there's two different liquids and they're immiscible. It's like oil and water. They don't want anything to do with each other. So the sulfides, they're dense. They drop down to the bottom and they stay liquid for a long time. So we need to figure out where those liquid sulfide deposits are, where they've cooled, where they've crystallized, and where they may have migrated to, because they do stay liquid quite long after the intrusion does. They can wiggle around and move.
Given that it's comparable plumbing systems here as well, I understand it's likely too early to have a definitive answer to this, but based on what you're seeing so far and what's being drilled in the region historically, does the potential for decent scale and continuity look promising to you right now?
Yeah, absolutely. I mean, that's one of the, to me, that's one of the most exciting things about Tamarack is it is a district scale intrusion. So it's 18 kilometers long. It's about 5 kilometers wide. It's really only been discovered in 2002. It has 30 meters of glacial till over the top. We don't have a single outcrop within 20 miles. And so it means it's been overlooked. Nobody knew about it until 2002. And then since then, it was really, only us and Rio Tinto that have worked on it. So you have this entire district where, yes, we found, a deposit, but it means that we haven't done a lot of work on the other areas yet. So as we started to drill up the resource and get the kind of the mine permit or the environmental work going, after that was done, that allowed us with our in-house rigs to go explore. And that's where we started going to the north, up into the Raptor Zone. Raptor Zone has two historic intercepts. One was just over 9% nickel and one was just over 10% nickel. The 9% one was a mile away or 1.5 kilometers away from the main zone. The second one was about 3 kilometers away from the main zone. And in between, you've got 1.5 kilometers of space that no one has ever drilled. So we started drilling there, and the first 9 holes of that program, 6 of those holes hit massive sulfide in a brand new area. So that's one of the areas where we're quite keen on. The results that we're seeing look very good. The grades are very good. The Raptor Zone does have more PGEs than the main zone, which I think might be an important point. And it's an area that deserves a lot of drilling.
How deep do you think you're going to have to drill this?
So it goes pretty shallow. It comes pretty much up to bedrock surface. We've hit good grades at 300 meters down, and then it does dip back to the south. So some of the massive sulfides were at 650, 700 meters down, well within reasonable mining depths.
Okay. So from the 30,000 meters of drilling that you're going to do, and I believe I mentioned at the beginning that you have 3 drill rigs, but you actually have 5, as you said, so 4 operating. But so from that 30,000 meters of drilling, what portion is going to go towards this new discovery?
I think we've got about 10,000 going to Raptor planned for this year. So the Raptor Zone is the kind of the newer discovery up to the north. That's about a mile away. As you noted, we did hit the CGO East kind of new discovery. So that's new since we put out kind of the plan for 2024. That's going to need some meters to kind of test that. And then we have some exciting targets in CGO East. On the northern side, there's a nice geophysical anomaly that says that there might be more mineralization there than we originally thought. That'll take some meters. And then we do have a massive sulfide extension to the south, which will also take some meters. That's the beauty of having your own drills. You can explore, and when you get new geophysical data or a new idea, you can go test it immediately.
And so in terms of chronology this year, what's going to get drilled first? When do you start drilling it? When do we see results? Yeah, walk me through sort of the strategy there.
Yeah, so Raptor Zone was this winter. We did a good little directional drilling campaign, and you're starting to see some of those results come out in the press releases. The rigs are now in the main zone right now, so we have a deep borehole that is going in under the deposit, and then we have rigs in the CGO East. From there, all the decisions are results driven. So we might need to spend more time in CGO East. We might have the ability to go to the massive sulfide, the main zone massive sulfide extension, and then Raptor Zone, of course, is where we're going to get back to.
You have indeed kept delivering at the Raptor Zone. It's 350 meters now. Is this extension coming as a surprise to you, or is it the same geological thesis that made the discovery, which is still intact here?
Yeah, so it is a different intrusion, and that's what I think has maybe thrown people off from it at the start. It's the Tamarack deposit really daylights and has eroded away up to the north. But as you go further to the north, you do hit this other intrusion, which is Raptor Zone. So I think of it as like a stacked intrusion, where you have two intrusions stacked on each other, but they're tilted up. And it wasn't until we started doing this drilling program that we saw how frequently we're hitting massive sulfides. And that's where the borehole EM really helps us. I mean, we can, in the press release that just went out, we had a nice borehole EM plate. You drill that, you hit massive sulfides, and it's just rinse and repeat.
Okay. Why I'm asking that really, Brian, is because you were quoted in that news release talking about the presence of pentlandite and chalcopyrite loop textures in that hole 505. And while I might have fooled Todd and Sean that I know what I'm talking about here, I don't. What is the significance of that? Like, why are you mentioning that in that quote?
Yeah, that quote was probably made for about 10 people, but seeing coarse-grained pentlandite is a really key indicator that your sulfides have cooled slowly. And that's important from a genetic point of view. It means the system is well evolved and it's a long system, so it's seeing a lot of magma. That really helps on the exploration side, knowing that you're not looking for just a one and done. This is a system that is pumping out a lot of magma and seeing a lot of metals. From a practical standpoint, when you see coarse pentlandites like that, it means metallurgy is going to be very good. The other side of this is when your sulfides cool down and they solidify, they do it in an order. So pyrrhotite, which is iron and sulfide, that freezes first and forms, large pyrrhotite crystals. But if you can do it slowly, it can kick out the copper and the nickel away from the crystal lattice. And what you end up with is a loop texture. And so you see these on projects that have these large deposit, like Voisey's Bay is a good example of a project that has loop textures. The loop will be a chalcopyrite loop with pentlandite. And the important part about that is because chalcopyrite and pentlandite cool at a lower temperature, it continues to allow the massive sulfides to move, to drain, and to collect in pools or plunge pools. So when you see that, you need to think, okay, there's sulfides here, but they cooled slowly and they could have moved, they could have migrated, and they're getting better and better, higher and higher grade as they continue down. So loop textures shows you high grade, awesome metallurgy, and a really, really nice magmatic system.
Is that also telling you something about where you're going to have to chase this from here? Because I believe the news release was also saying that it's open in all directions, basically. So where do you chase it from here?
Yeah, downstrike. I mean, sulfides are simple. All they want to do is follow gravity. They're really dense. They're liquid when everything else is liquid. They got one thing on their mind, and it's going down. So that's really what we do is follow gravity. That's one of the nice things about Tamarack, because really tectonically nothing has happened here. It's a great example of what an intrusion kind of looks like in space. It hasn't been tilted, chopped up, faulted, or anything like that. It's a really nice in situ kind of model. And so we can just follow it down, plunge pretty easily, and use the borehole EM as the guide.
So how deep? I mean, same question as the previous zone.
Well, and that's a great question, because when you look at what CGO West was for us, it was the same thing. It was these, relatively thin 1 to 2 meter intercepts of massive sulfide. it was a little shallower, but it's dipping and flowing down plunge. And we thought, well, this will just continue until all of a sudden it went vertical. It went from a flat 50-degree dip to a waterfall, and that's where it thickened up. And there's no reason to think that you couldn't have a plunge pool or something like that at the bottom. And when you look at that waterfall, I mean, that's one of the best intercepts of grade that we've had so far. One of the holes, I think it was hole 330, had a sample that was 12% nickel and 16.5% copper, in addition to about 10 grams PGEs.
Yeah.
So we're seeing outrageous grades, again, coupled with the loop textures.
Are there any other implications to that high grade? Because I know high grade's good, but sometimes high grade can also be too high. I mean, we're not talking about uranium exploration here, but I recently interviewed Lee Courier of Next Gen Energy. They have incredibly high uranium grades that could potentially be challenging for long hole stoping because of radiation exposure. In your case, no radiation exposure, no, none of that. But could there be any other geological implications to it being that high grade?
I mean, I've never complained about high grade, but you know, the only thing would be on the production side. If you slam your mill with a bunch of high grade, they need to catch up. So one of the things that we can definitely do is blend. So you take a piece of the high grade, take a piece of lower grade, and make.
Yeah, I was just teasing Brian. I said he'd never complain about high grade, or he'd never complain that his diamonds are too heavy.
No, that's a good point. But yeah, just kind of trying to understand that implication of the processing is a good point, Brian, as well. Good. Okay, that's giving me a better idea of what's happening. What else is he doing in terms of exploration outside of the two zones this year? We've I guess you're going, or you are in Michigan as we speak. What's happening there?
Yeah, so we are working in Michigan. We finished geophysics a couple weeks ago, and we have a drill rig on site right now. The Michigan story, I think, is probably one of the better stories. It was originally the Henry Ford land package. So Henry Ford purchased this land package from a British baron. And Henry Ford wanted to vertically integrate Model T production of lumber and steel. And so Ford actually had exploration team assessing mineral potential on the property. It's about 400 and some thousand acres. Ford has had it until the early 90s when it was sold off. So they sold the surface rights to timber companies, and they sold the mineral rights to Rio Tinto. Rio did exploration up until about 2013. And in that time period, they made the Eagle discovery, which is the only high-grade nickel deposit in America right now. They
The only high-grade operating mine, I suppose.
Yeah.
Yep. Okay.
They then sold that off to Lundin. Lundin made the Eagle East discovery, but the land package was sold off to another company. So we ended up getting that land package a couple years ago. And what I like about it, I mean, from an exploration standpoint, is there are a number of other intrusions on that land package that have really good grades. I mean, there's one that has 11.3% nickel equivalent massive sulfides that have been drilled. But that project has only had one hole of the 57 it has. One hole has borehole EM. So the critical tool, like our bread and butter tool for finding massive sulfides at Tamarack, has only been used on one hole on that project. And that project has beautiful massive sulfides. So that land package allows us to test a number of interesting targets that are there, different intrusions. And the fact that we have an in-house geologic team, in-house geophysics, and in-house drilling means that we can do kind of a fail-fast approach, where we can, if we see something that's interesting, we can just go drill it, and then you know. So you do that with a dozen targets. Most of them won't be, something of interest, but some of them will, and it's a quick way to kind of push something in further down the exploration pipeline.
I understand it also, again, might be too early to talk about this, but how many exploration seasons do you think you're going to need to come up with a maiden resource in Michigan?
Well, that's a tough question to ask, because it is, I mean, 400,000 acres, the entire Tamarack district is only 33,000. So it would be a long time. But the beauty is we do have really a world-class geophysical data set that we can leverage. the other thing with Michigan is it's private land and private geophysics, private data. So that's one of the kind of oddities is that there isn't. It's like if this were in Canada, it would have been picked over, 100 years ago. But because it's private land, there's really only, Rio Tinto has had a crack at it, and that's about it.
Makes it easier to permit though, as opposed to BLM land, I suppose.
Yeah, and they have a great track record with permitting Eagle.
Okay. But the work that you want to do right now, you're permitted, communities, fishes, birds, everybody happy up there?
We're drilling at the moment. Yeah.
Okay. Good. What about what's happening in Minnesota though? Do you think, because I raised the question of maiden resource, do you think what you're doing in Minnesota is going to be enough for an updated MRE this year, or are you going to have to go through another season?
So we haven't decided yet whether we're going to do an updated resource or just go straight to our feasibility study. At the moment, the current strategy is to go straight to the definitive feasibility study, which would contain an updated resource as part of it, and that would be late next year. But yeah, one of the debates we're having internally is, with all of the drilling success, do we want to do something to illustrate to the market what the impact has been from a resource standpoint?
But so you're skipping PEA, PFS, you're just going to DFS immediately.
Correct. We are.
Interesting. Is that because you want to get to that 2026 January production? Or
no, I would say that internally, and Brian, you can talk about this as well. I mean, we're currently at the stage where internally, in terms of the trade-off studies, et cetera, that we're doing, we're basically at PFS level. For us, it's about our approach to permitting and transparency. What we want to make sure is that at the time that we come out with our feasibility study, which is going to contain our mine plan, that will be reflective of the process that we're going through right now in permitting, which Todd can talk about, where we're basically going through an engagement process now with the Department of Natural Resources and with other groups, and getting feedback on initial thoughts on the mine plan. And so what we really want to do is come out with that definitive mine plan that's taken into consideration all of the thoughtful comments and feedback that we've received along the way. Todd, I'm sure you want to add to that.
Yeah, I mean, the process in Minnesota is unique. It starts off with something called environmental review. That's in front of the actual development of a EIS, a draft EIS, and a public comment period that turns into a final EIS. The environmental review process involves all of the regulatory agencies that protect the environment in Minnesota, and all of the tribal sovereign governments in Minnesota are invited to participate on a pari passu basis with the state's agencies. And you go through this iterative process of questions and requests for data, suggestions, and then we reply to them. So we're on our second round of this. What we're hearing is some really interesting points about need for certain points of data that we've either obtained or will obtain. Questions about whether things could be done slightly differently. And we can reply with narrative answers, we can reply with additional data, or we can actually reply with project changes. And that's what we're in the process of doing, is trying to find incremental improvements to the project that maybe are responsive to some of the concerns of the community or of the regulatory agencies or the tribes. And that hopefully then when we get to the public comment period, we've got a project that people feel has been through this environmental review process, had kind of people kicking the tires of the initial plan, which again, we felt was responsive to some of the concerns we heard in our quarterly community meetings. But we can do more, we can do better. And so I'm really excited about this process and what it will mean for a project that has been through some testing and some questioning, and that's all very healthy.
I believe that, just like Brian and I just discussed, sulfide ore hasn't been mined yet in this region, and I know not all locals are going to be completely happy. All locals are never completely happy with one thing. No. But what exactly are you doing in terms of community engagement or like kind of keeping the communities happy? Because if 2024 has taught us one thing, then that's that community engagement is just getting more and more important over time,
Yeah.
getting everybody on board or as many people as possible. So what are you doing
Yeah.
more specifically outside of what you have to do?
So, we've actually, since Talon took over the project, had what we call our open door policy, where we had, people stop by, they ask questions. People in the region, that particularly people that live there year round, feel comfortable stopping by, asking a question. We try and be present in the community and go to local festivals and put up a stand and have our teams there to answer questions. And then we've instituted a policy for the last 2 years of quarterly community meetings. And, some of those involve community supporters. Some people haven't made up their mind, and some people are opponents, and that's okay. We understand that people are concerned about what the impacts of a sulfide mine would be in a water-rich environment. We're in central Minnesota. We're about 45 minutes west of Duluth, so we're not in the boundary waters, but we are in a very sensitive, high, water area that contains a lot of precious wetlands that also are very, very important to the Native American communities that are in that region, where they have been hunting, fishing, collecting wild rice, collecting medicinal herbs for millennia. And they have not only their reservation lands, but they have treaty rights outside the reservation lands that are all around us. And we understand that that context and that connectivity. We'll probably never understand, as not being Native American ourselves, many of us, the depth of the cultural importance. But what we are trying to do is understand it as best we can, and then try and design the project in a way that addresses as many concerns as we possibly can. There absolutely will be people, it's not enough. But what we're trying to demonstrate is that we are listening, and that not just listening, but taking action on what people have expressed as concerns. So for instance, one of the biggest things we did 1.5 years ago was take the processing of the ore and crushing activities, and then the waste management of that product. And we moved it from the water-rich environment where Mother Nature placed the high-grade ore, and we moved it to a drier environment in central North Dakota, Mercer County, to an existing industrial site that has lots of beneficial and reusable infrastructure for us. But it also has some attributes that will allow us to do a better way of doing tailings management and waste storage. It'll be in a drier environment. It'll use an industrial site that already exists. And it really doesn't add a lot of incremental cost, because we're on a straight shot from the site in Minnesota to the site in North Dakota, all on the BNSF railroad. So even though some people it won't be enough, at least I think people feel we are trying to be responsive to people's concerns. And ultimately, our team lives in that region. Brian lives there. Our communities team lives there. Our drillers and geophysicists live in that region, and they don't want to see the environment affected any more than anybody else does. And I think that for our part, we just don't think it has to be a choice. We think you can take the materials that are needed in the energy transition or in defense systems like nickel, extract them responsibly, create good high-paying jobs, and protect the environment. And that's just the difference, where there are certainly people think that it's axiomatic that there will be a negative effect. And during this process, we're going to have to show that it doesn't have to be a choice.
Is the cost for doing that additional community engagement work and the cost for the G&A, by the way, the G&A that you'll be spending on, was that included in the budget that we were talking about at the beginning?
Yes.
Okay.
So, taking the time to engage in the community, having an open door policy, having our team show up at local fairs and things, doesn't cost a lot of money. Our teams want to do that. They want to talk to their neighbors about what they're doing. They're very proud of the fact that we're part of the energy transition, or that have a partnership with the Department of Defense. Some of our people are veterans, and they take that very seriously. So there's a lot of pride in our team, and people want to engage, and proud to tell people what they're working on.
Okay, so with the with the additional efforts that you're making here, are you going to be on time to honor that 2026 production commitment that you have with Tesla? Again, because we touched upon it briefly, but that wasn't clear as to how much of a priority is that?
So if you look at our website, we have an updated sort of pathway to production now that's now showing production in 2027. And those are the discussions that we've had with Tesla. So that's the current intention.
What would that be? I suppose I could pull it up here to look at it right now, but
Sure.
what does that, yeah, what does that put you in terms of production?
So we're talking late 2027 in terms of first production.
Okay. Well, what happens then to that agreement? I suppose there was an amendment clause in it that it could be amended, but it was something of the like to the tune of 12 months, I believe. How's that going to look like?
So our current agreement with Tesla is that we get into production in 2027, which they're comfortable with, and then there is a right to extend that out, kick that out by potentially up to another year. The reality is that, again, we talk to Tesla quite regularly, and work closely with them on all of this. I mean, the reality is that there's just such an immense need for the nickel that again, as the timing evolved, there was really no issue. I mean, at the end of the day, as Todd talked about earlier, I mean, the batteries are extremely nickel heavy at the moment. There's a need for nickel, so no concerns on it. It's actually been very much a partnership approach to it.
If you, that's the thing I wanted to emphasize. In our press release, I mean, Tesla rarely comments in the media, and they put a quote in our press release. And they let us call it a partnership, and it really has been a partnership. So there's really been helpful to us in the permitting process. They've been helpful in terms of introducing us to NGOs that they work with on climate change policy. Or, one of the things that we have to be sure of is that we can trace our minerals all the way from the mine through to Tesla through to recyclers. So we'll have some announcements on that coming up about traceability, but that's an important thing because what we want to take out of the ground in Minnesota is infinitely recyclable. That nickel is infinitely recyclable. And so it's really important that the minerals that are produced at high standards are traced and tracked and identifiable as we build the supply chain for clean energy systems, so that in the future, Brian and Sean's kids will be able to have more of a circular economy, a circular system for the supply of clean energy system materials.
Where does all this place you in terms of the ownership of Tamarack? Do you still have the intention to go for the additional 9%? And again, there's a timeline to that as well. I believe it was 2026.
The answer is, oh, yes. So the game plan at the moment is sort of mid-late next year. We intend to deliver the feasibility study, and then we would pay Rio the $10 million to earn that 60% interest. But there is a definitive intention to do that. Absolutely.
Okay. What's the plan for financing it? If it's definitive equity or debt combination, what are you thinking?
I mean, again, we'll see what the world looks like at the time. I mean, if you look at history with us, I mean, you had mentioned at the get-go that Rio has a small equity position in Talon. Just to give you some color and background to that, there was some historical payments that were owed to Rio as part of the agreement, and they wanted to take it in equity instead of cash. So we'll just see. Again, Rio is a great partner. We talk to them regularly as well. They're, huge proponents of what's happening at the project right now. So we'll figure out whether it's just a cash payment, whether we raise that money, whether it's some other arrangement with Rio.
Grants? I mean, is that something else that would be? Will there be more money available? Is there an expectation for it?
Yeah, absolutely. There's quite a few new areas that we can go for grants, particularly around some of the innovation work that we're doing, where There's new technology from the national labs. There's new technology from universities and startup companies. And there's a lot of money from the IRA, from the bipartisan infrastructure law, where novel science or technology can be demonstrated at pilot level. So if you think about trying to take a full value mining approach and take all of the valuable materials that are in the ore out and extract as much juice from the orange, we can get quite a bit of funding for that and have already gotten that, or our partners have gotten that. So I absolutely think that's important. The other thing that I'd like to just point out, Antonio, is the Department of Energy's Loan Program Office just announced 2 weeks ago that they've changed their rules and they can now provide low-cost government-level financing for mine projects in the United States, not just processing. So that government financing, that ability to borrow from the US government to build the whole project from the mine to the processing plant is a massive change and a real game changer for us.
But the intention remains you go for the 60%, and then when you do the feasibility, pay the 10 million, you go for the 60%, and then the intention is to build it together with Rio, or is it to get Rio to buy that 60% back from you and have them build it, you have an exit?
So the way the agreement works with Rio is once we earn our 60% interest, then it's a straight fund or dilute relationship. So we're the operator of the project. We come up with the budgets and programs. We present them to Rio. Rio has a certain amount of time to elect whether they're in or they're out. And they either fund their capital or they're subject to dilution. At the moment, the plan is we're going in terms of the partnership intention, which is to get there and be 60-40 partners on the project.
Is there an operating fee or a management fee or something?
There is, and it depends on the various stages of the project, but it can go upwards of 10% management fee under the agreement. One question I get from shareholders, investors sometimes is, whether there's any type of clawback right by Rio, whether there's a right for Rio to increase their interest, and the answer is no. I mean, again, it ends up being a straight 60-40 relationship where us as the operator are in control, and it's as straightforward as that.
So if Rio wants that 60%, the only way for them to get it is to buy it from you.
They would have to make an offer like everybody else, correct?
Okay. Well, everybody else is an interesting leeway too, because I'm thinking, could there be somebody else? I mean, with the presence of Rio, is there really a room for someone else? Like, could BHP come in and start dealing with this? I don't know if I could see it, but what do you think?
Well, look, I won't speculate on who the buyers would be, but I mean, if you look at our broad strategy as a company, we're not limited to Tamarack. We've got Minnesota, we've got Michigan. Our goal is to be the high-grade nickel producer in the United States. If you look at the two projects jointly together, in terms of our overall, let's say, aspirations as a company, we're hoping that one day we're producing 20,000 tons per annum out of each of Minnesota and Michigan. So, I think that if you look at the nickel players around the world, in terms of a production at this point in time out of the United States, there's a lot of strategic value to being a nickel producer in the United States. But in terms of the way we're approaching it, I mean, we've built the team. We currently have more than 100 people that work with Talon. We're building the team to take the project forward. And as I said, be 60-40 joint venture partners with Rio.
Quite the team, 100 people. I wouldn't have expected it to be that big. You were running $210,000 a month in G&A. What's the budget for this year? Thinking to keep the G&A or lower and higher it?
Everything's going to remain the same. It's in terms of allocation towards exploration team and the permitting team. But again, Brian can elaborate on this more. We touched on the rigs that we have. We currently have our own in-house drill team that run the rigs. We run the rig, so we're able to run the rigs on a 24/7 basis. Geophysics, we've got our own geophysical equipment. We have our own in-house geophysics team. We have a head of permitting. We have a team that deals with the community. So as I said, we're built to take this thing forward.
And just one comment on that is that that's where the non-dilutive grants from the government really help. So they've come in at a crucial time that really facilitate some of that work. And that money, they want us to be spending some of that money on things like the environmental studies, the community engagement. So that money can be spent on those activities, and it's vital and crucial, and just came at a really nice time for us.
Okay, and geophysics was in-house. What else? Yeah, I'm just thinking of what else you'd be spending money on. Something that I might be missing. But no, I mean, at the beginning we also talked about, you told me that it covers everything. I mean, what I have the financials here in front of me, so the 210 covers here. Was this an exceptional quarter that I covered, by the way, the last one, because it was about 8% of all the money you spent was G&A, and 92% was going into the ground. Typically, I'd say, an 80-20 or 70-30 split, but with you, it was more than 90% of money was going into the ground. Is that a typical split you want to go for? Is that something you're actively thinking about?
I think over time, we'll see, the split towards, exploration and permitting change somewhat, but no, it's typical for us for sure.
Okay. Okay, good. Good. Well, what am I forgetting to ask you here? This has been it's been a good conversation. It's been a good back and forth between the four of us. What am I forgetting to bring up that you hope to talk about?
Well, I'm sitting in Washington, and maybe I'll just give you a little bit of a look from Washington about the policy outlook for the U.S. government. We just had the benchmark Giga Factory conference here in Washington. A lot of government speakers, and a lot of people in nickel are focused on Chinese investment in Indonesia and this role of Indonesian nickel. And, I think people do need to do their homework on the IRA and the foreign entity of concern rules and the sourcing requirements of the Section 30D provision, which goes to the $7,500 per vehicle of the EV. And Senator Manchin spoke at the benchmark conference, and he was really focused on this idea that the goal of the IRA is to take clean energy to scale, but it's also to make sure from a national security standpoint that we have secure supply chains. And that just means that the preferences for minerals produced in countries where there are high standards for labor and environment protection will remain. In any election scenario, that's going to be something that will still be a big priority. We have yet to see the final rules about the production tax credit, Section 45X, that pertains to production of critical minerals in the United States. I'm quite keen on that. It's the only provision in that area that never has a sunset. And in critical minerals, it's quite a big benefit. It's 10% of your production cost paid for out of a tax credit from the US government. So there's a lot of policy drivers that are really interesting in the critical minerals space. There's a read across between the Biden outlook and the Trump outlook. Quite frankly, very big priority of critical minerals from a national security standpoint. It's something that I don't anticipate a change in either outcome on the election. And then finally, there's been a lot of focus on Indonesian nickel and it getting into the IRA compliant supply chain through the US doing some sort of critical minerals agreement with Indonesia. There's been strong pushback on that from the US Senate. There were 9 senators that wrote a very strongly worded letter to President Biden on that. And then as we've seen Chinese nickel undermine existing projects in Australia and Canada and things like that, you've seen major allies like Australia and Canada actually engage the US government on that and push back on the idea of getting Chinese nickel from Indonesia as eligible for the IRA. So I don't see there's a lot of risk for that. I don't see the United States doing a critical minerals agreement with Indonesia. It is going to mean that there's going to be a strong preference for battery materials from existing free trade agreement countries like Canada, Australia, Chile, Morocco, South Korea, and Japan. And there's more than enough geology that can supply the US demand from those places. So people shouldn't count out that geology anytime soon. So I'm really bullish on the policy overlay for our great asset and for these high grades that we've got in the ground.
It is a good recap. I don't have too much to add there. I try to focus mostly on the asset and then follow it up that way, sort of from the bottom up. But that also is important and it makes sense. So yeah, gentlemen, this has been a good overview. Brian, what about you? You've been silent for the last couple of 20 minutes or so, but we used you a little bit for the geology there. What are we missing on the geology? Anything that we're forgetting to ask you?
No, I'd say just watch the space. We keep drilling. You know, we're going to drill 30,000 meters this year between Minnesota and Michigan. And yeah, Todd's got a piece of what our ore looks like.
Little show and tell here,
Yeah.
right out of the ground, pretty shiny.
I mean, one of my favorite things last year was drilling the drill hole that ended up being, like you said, the #1 nickel intercept on the globe for 2023. And to me, that's just a reminder of what this Tamarack system can deliver. We've only explored a small part of the Tamarack district. And so, you know, for me, it's super exciting seeing that intercept and just knowing that there are other spots on this intrusion that haven't been drilled yet.
What's the thing that you held up, Todd?
It's a core sample.
What do you think that's grading, Brian? What do you think it's grading?
That'll be 9 to 10.
Okay, well, but it's mostly chalco, right? That we're looking at, chalcopyrite?
Nope, that's pure type pentlandite and then a smaller amount of chalcopyrite.
Oh, okay. Yeah, maybe I couldn't hear. So it's not orange, it's gray?
Oh, no, sorry. It's just the camera.
Oh, okay.
Just pretty metallic.
Okay.
And really heavy.
Okay. Good. Well, I have an affinity for orange given my hair color, but
as we're talking about grade, I mean, look, it's making me think just one story I want to tell quickly. You know, when we got involved in the project originally, I mean, everyone always talks about how grade is king. I remember I was driving my car and I got a call from someone that was in corporate development from Rio Tinto, and they were talking about, they were asking whether this is a project that we might want to get involved in. And, you know, they were telling me that, you know, the grades of the project, they were hitting 7-8% nickel. And I remember reaching out to, you know, my partner in this company, Henry Van Rooyen, who's our CEO, and saying to Henry, you know, we had this conversation, 7% nickel. And Henry said, I think you're mistaken. I think it's supposed to be 0.7% nickel. And I called back and I actually called Rio Tinto back and I said, I think there's a mistake here. And anyway, long story short, you know, Henry and I ended up in Rio Tinto's office the very next day, booking one-way tickets and saying that we weren't leaving until, you know, we could be a part of this project. And, you know, it continues to give. And, you know, the comment I'll make for, again, shareholders, investors, is that I think it's important to follow the tea leaves in terms of, you look at what's going on in the nickel world right now, and there's been some projects that have been shut down. But again, if you look at the high grade projects globally, those withstand any nickel environment. And that's why when I talk about keeping the pedal to the metal with these projects, it makes sense, because these are going to be projects that no matter what happens in the nickel world, if the price goes up, great. But if you would have told us as we were getting involved in this project originally, a long-term nickel price of $8 per pound, you know, we would have been dancing, quite honestly. So, you know, that's what excites me about Tamarack and Michigan as we talk about grade. It's the fact that we know we're going to put this into production and we know that it's going to be economically viable.
Good. Well, Sean, that's a good note to end it on. Sean, Brian, Todd, gentlemen, thank you so much for investing your time with me today. This was great. Hopefully we can do it again in the future as the results start rolling in. All right, moving on, I'm going back to Europe, and that'll be Finland specifically, where I'll be looking for energy metals and lithium. specifically together with Jeremy Poirier, the CEO of European Energy Metals Corp. That's a company listed as FIN, that will be FIN, on the TSXV in Canada, where an average of about 16,000 shares trade each day, with a 52-week high of 70 cents and a 52-week low of 17 cents. With a market cap of about $11.5 million and about 37 million shares outstanding, today this is a 31-cent stock. There are 13.6 million warrants, about 1 million options, and about 1 million RSUs, leaving us at, call it, a little over 50 million fully diluted shares. Although it is worth noting that some of these warrants and some of these options are in the money right now. Looking at the latest balance sheet, which is dated or was reported on February 29, the company had about $2.5 million in current assets. Virtually all of it, so 2.4 million to be specific, was in cash, of course, with some account receivables and a small portion of a prepaid expense. There's no long-term debt. There's barely any current liabilities too, with about 200 grand in account payables, most of which is related to management fees and other related party transactions. That same financial statement tells me, and it is from February, again, end of February, that tells me that on average, over the last reported 3 months, European recorded about $300,000 in operating expenses. That's in total for the 3 months, a bit less than what a typical quarter would cost them, actually, because the average over the last 9 reported months in total, the corporate cost has been about $530,000 per quarter. Taking out share-based compensation, that brings us to about $135,000 of out-of-pocket money for the G&A, most of which was in the form of investor relations and communications. As to the exploration and evaluation expenses, those sat at about $150,000 a month, mostly focused on the central Finland property, of course, where a total of $1.3 million was spent over the last reported 9 months. This makes for a G&A to exploration ratio split of about 45 to 55%. So 45 G&A, 55 goes in the ground. As always, though, this financial report is nothing more than a snapshot in time. In this case specifically, that was happening at the end of February of this year, and the finance are going to have changed by the time you're watching this. So please do head over to the company's website, as well as setterplus.ca, both of which are going to be linked somewhere in the show notes, and it is your responsibility to look at the numbers yourself and make sure that you're getting the full picture. Talking about full pictures here, that's enough finance for at least a couple of days for me, because I want to talk to you about the company's projects. It is a portfolio of projects, actually, that we'll be looking into, and it covers over 2,300 square kilometers of land, so it's rather big, and focuses on hard rock lithium, so that'd be your LCT pegmatite exploration assets. That portfolio of assets was until recently under an option agreement from another company known to the channel that is run by good man Eric Roth, and he runs a company by the name of Capella Resources. And the option agreement was then amended not too long ago, so all that was left for European was to pay a $250,000 cash payment and issue 1.1 million common shares to Capella in order to earn in 100% of this project. And so they did. That payment was completed last month, and so Capella now has a 2% NSR in the project, but European owns 100% of the concessions. Shortly thereafter, the 2024 exploration program was announced for this project, aimed at basically following up the 2023 one, which discovered spodumene-bearing pegmatites, with the highlight of that program being the discovery of Kairola, which is a 350 by 110 meter boulder field with there's been some rock chip samples taken out of it, and those rock chip samples have shown that the boulder field, some of those boulders contain lithium mineralization. More specifically, what's happening at the project right now is basically target refining, companies looking for drill targets through a series of tests, of course, including mapping, trenching. There's some geophysics and some geochem happening as well, which will hopefully help them again come up with targets that will then be drilled later this year, which of course will be a point of discussion later today, and financing dependent, I assume. But again, I'll ask about that later on. European Energy also has some gold projects, multiple. Let's not forget the S, and this isn't typical for a company with energy in its name, of course. So again, hopefully something we can touch upon later on in the conversation. But the company has 5 separate concessions that are focused on gold exploration. They cover about 3,000 square kilometers of land, mostly in the central Lapland Greenstone Belt, so they're still in Finland. And there will be some, not a lot as far as I understand it, but some work done on these projects this summer as well. So yes, early stage exploration of both the lithium and the gold, which means plenty of barbecuing, grilling to be done here. But before we get into all that, Jeremy, European Energy was actually initially listed as under a different company name with somewhat of a different focus too, and that wasn't too long ago. I believe it got listed. Initially, you got listed in 2021, and then you ended up going after Capella's assets, turned the focus to lithium just about a year ago. Why the quick change? What happened there?
Yeah, we actually were a spin out of a company called Golden Independence, which was focused on a project in Nevada, and they had an asset in the Kootenays in British Columbia, Canada, that they wanted to monetize. So they spun it out and then they listed it. And then us as new management, we evaluated that asset, and although it looked interesting, we thought, we had an opportunity to work on a lithium project in central Finland with some people that I've worked with in the past, that I've had success with in the past, and we thought it was a good time to change focus. So I guess what you would say is that that project we had with a company called Hilo was an earlier stage, and we thought we had an opportunity here to add some significant value for shareholders by doing a deal with Capella, as you mentioned.
But okay, so these gold projects that I mentioned, the 5 gold projects, rather large land package too that you have right now, are they related to the previous to the Spinco, or like how did that work?
No, they're not actually. The Spinco, the project was in British Columbia, Canada. So the gold projects in the north, those actually came in and around the same time that Mike Basha, our VPX, who's he's had a lot of success in the past with discoveries in northern Finland. So those were projects that he identified as he came over, and he recommended that we take a look at these projects as well. And they're right on strike with his discovery with Orion that eventually brought in B2 Gold, and then recently Rupert Resources actually bought out B2 Gold for about 100 million shares. I think it was just over $110 million worth of their shares. So yeah, he recommended those projects in the north. He's done some previous work on them, and they were a little bit more advanced than what we had. So those came after our lithium. After we signed the deal with Capella on the lithium projects in central Finland.
Right. So what's then the plan with, first of all, getting these projects in a portfolio, and has that plan changed since then? What's the plan right now?
Plan right now is we actually kicked off our 2024 exploration program. That kicked off early June, and it's going to probably go through to sort of end of October, depending on weather. And the plan right now is to follow up on that significant boulder discovery we had in central Finland, and then eventually follow up with some drilling, some trenching, and then we've also recently picked up some additional reservations that we think are strategic to the area. And then probably in July, when the snow melts in the north, or not probably, the plan in July when the snow melts in the north is to actually follow up on some of those previous results on the gold and go do some work on those gold projects. And we think we can develop some pretty exciting drill targets on both projects, and something that that investors would be very interested in, and larger multinational companies as well.
What kind of land are these the gold projects on, by the way? Government, private?
Yeah, it's all government. They call them reservations. So yeah, all of the land is government, or it can be private landowners as well. But the stuff in the north is mostly government, and then the stuff in the central, you have a mix of private landowners and government.
So why I'm asking is because I'm trying to figure out what your holding cost is for, and again, for now, I'm just focusing on the gold projects. We're going to be talking about the lithium projects for sure, but just trying to understand the gold projects.
Yeah, the gold projects in the north, the holding costs on those are zero. So the reservations, you don't have holding costs, but you only have 3 years, well, 2 years, and then you have a sort of a cool down period, which is the moratorium after your reservations expire. So you basically have 3 years in order to complete enough work. And then once you move to exploration permits, which would allow you to do drilling and a little bit more land, or just more land disturbance, I should say, those cost about $5 to $10 a hectare that you have to pay yearly. But the current reservations we have in the north, they're just reservations, and they don't cost anything right now.
Okay, so you just but do you have work commitments? Like, is there a minimum of
No work commitments at all. So basically, you get the reservations, and you would let's say, they don't call it staking here, but for a lot of people, they're pretty familiar with that term. So call it staking, these reservations. And then, you would stake a large land package. And then once you narrow down to exactly what you want, then you would apply to the government for reservation permits. And then when those reservation permits are granted, that's when you make your payment.
All right,
So
so yeah.
right now, we're just in the reservations in the north, so we don't have any work commitments, or money owed to the government. The only thing that we have is we have a limited window that we need to do work and to confirm what we think is up there, and then at that point in time, we'll apply for reservation permits and get ready to drill.
Okay, that makes sense. I called them concessions earlier. They're reservations.
Yeah,
That's the
no,
word that I was looking
yeah,
for.
reservations here, correct? Yeah,
That's
that'd be the
right.
proper term here in Finland. But depending on the country, they're staking, concessions, reservations are all sort of the same.
Yeah, makes sense. Good. What is then the long-term plan or strategy though with these gold projects? Again, you're a European energy, so how does gold fit within that strategy for you?
I think the gold projects are something that we can monetize, whether that be a spin out or if the lithium were a spin out. Like, I think we're going to have assets here. We're going to have energy metal assets in central Finland. We're going to have precious metal, potentially copper assets in the north. So depending on what those look like, you're going to have two assets, and then at that point in time, it's our job to figure out what the best strategy is in order to create value for shareholders, whether it's monetization, whether it's a spin out, whether you sell it to a larger company, joint venture with a larger company. So right now we need to confirm what we have here, and then we'll figure out what the best way forward is to create value for shareholders.
At what stage do you think those assets are monetizable? Like, do you want to have them drilled or just
I'd say at the end of this working season, I think they'll be in a position where we can talk to large multinational companies, and potentially look at some very exciting targets.
Right. Okay. How much money are you budgeting this year for the gold stuff?
Well, our total exploration budget for this year currently, and this is about 2.7 million. If you back out the drilling, you're about 1.5 million.
That's total though. That's for lithium and gold.
Correct. Yes.
So what percentage of that is going to go into gold?
I would say probably 40% in the gold and 60% in the lithium.
Okay, so still a decent chunk. So
don't hold me to that, but as a sort of we'll see once we get up there. We'll see how it works. We'll see how many samples we're taking, how much time we're spending in the field. But I'd say at this point in time, that's a pretty good guesstimate.
Good. Okay, we're going to be talking about the lithium assets and the money that you're going to be spending there. You had a technical report that is, by the way, again, for people listening, setterplus.ca. People can go and read that report, and they should. But talking about permits and all that land that you got, you said that you have like 71% of the NABA reservation on the lithium stuff earlier this year. You said that 71% of it was you got a permit basically for 71% of the land, which is kind of an interesting number, 71%. Where does that number come from? Yeah, so I had mentioned the reservations earlier in our conversation. So last year, all we had for the lithium was reservations. So we did a pretty substantial exploration program, and we narrowed down the areas because keep in mind we had like 2,400 square kilometers. That's way more land than you're ultimately going to need for a mine, and it's hard to sort of fathom how large that is. If we were to drive across our entire land position last year, it could take you an hour and a half to 2 hours, right? Depending on if you're east-west, if you're going diagonal or north-south, or, it really depends. So what we did after that program is we figured out, okay, here are the areas where we've got some exciting results. Here are the areas where we need to drill or explore more extensively, whether that be bottom of till or trenching. So once those areas were identified, then we applied for those exploration permits, and it just happened that it ended up being 71% of the NABA concession. So, and, also keep in mind that, it's pretty wet in that area of Finland. So some areas once you realize, okay, well, there's nothing, this is a bit of maybe a lake here or something that isn't applicable necessarily to having an exploration of permit. So, as I said, you start large and then you narrow down. But I guess what that number says is that,
we ended up applying for an exploration permit on 71% of the land on Naba after last year's exploration program.
2,300 square kilometers is about the size of the country of Luxembourg, actually. So it's rather big.
There you go. That's a good fact. But yeah, so that gives some people some context for what I'm talking about.
Yeah, it also makes me look smarter than I am because I actually had to look it up for another company that I put my money in because they have 2,500 square kilometers and in Africa though. So, but anyways, that's why I know. The technical report that you published earlier this year, I believe, it recommended that you spend about 1.5 million Canadian dollars of exploration work on in 2 phases on the lithium stuff. Is that what you're following as sort of a base outline for the work?
Yeah, I think that's probably the correct way to say it. And yeah, I think that's accurate. Like, that would be sort of follow the typical mining timeline and recommendations. You do a program, you narrow down your targets, you come up with a report so you can sort of talk intelligently about the property and something that you can talk to investors and technical people about. And then you have an idea of timeline and will it be exact? It never is, but yeah, I think it's a good framework. And that was achieved from last year's exploration program.
Right. Well, listen, talk about, and what I'm asking is just sort of set the stage, confirm the cost, and then talk specifically about what that money is going to be spent on. Because again, as far as I understand, as I mentioned, you're doing mapping, trenching, geophysics, and some geochem.
That's correct.
Okay. Is that, and how long do you want to spend on doing that? Like how many months?
You're probably looking at June to October, depending on weather.
That's right. Okay. And then once you have results from that, then that's going to be the drill targets and then drilling.
Yeah, and so in Finland, you have a working season for let's say surface work, trenching, sampling, those types of things. But drilling is actually, even though you can do it year round, drilling is actually better to do in the winter because you have less disturbance, right? Because there's snow on the ground, so it's easier to move the drill rig around. So drilling's actually easier to do in the winter. So it makes sense that maybe we'd have a drill program sort of fourth quarter of 2024 potentially. And I don't want to say that's a certainty, but that would make some sense, and that's sort of part of our plans right now.
Right. I do want to talk about what else that's contingent on, which is potentially market forces and financing, but we'll get to that later on. What's interesting here in this region specifically is the presence of rare earth granitic pegmatites as well, which can have similar physical appearances as well as comparable mineralogies to the good stuff, to the pegmatites that you want to be looking for that have lithium in them. How are you going to be dealing with that? And how's is that the right? Anyways, let's answer that first question. How are you going to be dealing with that?
With the rare earths?
Yes, generally because the pegmatites, the rare earth pegmatites and granitic pegmatites, they just have a similar appearance to the lithium pegmatites that you would want to be looking for. So
yeah, so all of our research that we've and data that we've reviewed, and a lot of the data that we've reviewed is from the Calibre mine, which is being built. They're spending about 700 euros on that right now, and that's owned by Sibanye. And that, that's going to be 15,000 tons per annum, 16 years. That's going to be online back half of next year. We actually visited the site yesterday. And as a side note, they've been actually doing some substantial drilling, and I think their initial resource was about 9 million tons of lithium, and now it's up to over 20 or somewhere around 20. So they're going to continue to expand that resource. So the area is very prolific for lithium. But one of the things that we did as part of our due diligence is that we reviewed a lot of their data. And so what we've discovered and what we believe, and this is part of our model, is that granite that you talk, that parent granite, we would call it, that's actually the source of the lithium in the area. So it's actually quite helpful as part of our a tool that we're using to figure exactly what the geological model could look like, and then to confirm our thesis.
Talk to me more about that, because you often compare yourself to Calibre's deposit close to that Naba reservation. What are some of the geological similarities that make you confident in that comparison in terms of, again, your thesis in the structural controls or the lithology and so on?
Well, you talked about the structural controls, and that was the parent granite that we just talked about. So, but some other things that we looked at is boulders. boulders in Finland, specifically this area, are very important, right? They sort of, usually they're pretty close to the source. And as you mentioned earlier in the call, we had a significant boulder discovery of close to a kilometer that was grading very high lithium spodumene. So we're using that. And then the other thing is we're looking at the ice direction. The ice direction is very important, and we're also looking at orientations, and our ice direction orientations are almost the exact same as what Calibre is. So we expect to have something similar. And we won't know until it's confirmed, but that's our expectation. And the lithium deposits here, think of them more so as cluster deposit as opposed to sort of one, long, let's say, string of pearls is how I would say it. But you have multiple clusters deposits in a in a small area, and that's what you have with the Calibre deposit.
So basically, your internal geological thesis on how the potential mineralization got there is saying that it was one and the same mineralizing event for Calibre and what you potentially have.
Yes, and there's a couple other companies in the area as well, and they share our thesis, and all the data that we've seen from them would indicate that we're on the right track as well.
Have you done fluid inclusion studies, or are you going to be doing fluid inclusion studies to confirm on how that mineralization got there in the first place?
That's not currently part of the program, but that could change in the future.
Okay, but do you have to? Again, I sound smarter than I am. I was reading up through that technical report, and I saw some of these things in there, and I'm thinking, like, is this a must? Like, do they have to do fluid inclusion studies and stuff like that?
You don't have to. I think what it comes down to is what level of comfort do you want before you drill, right? I mean, theoretically, we could just go somewhere and just drill a hole, and we may hit, or sort of confirm what we think. But our team wants to make sure that before we do that we're as confident in our models as we can possibly be. Now, there's always some chance when you're drilling, but we think with everything that we've seen, and if we continue and if this field program from this season comes up with to confirm even more what our thesis currently is, then we're going to be pretty excited to drill and prove that out.
Do you know if Calibre is dealing with the same, or was dealing with the same type of overburden that you're dealing with on that boulder field?
Yeah, I would expect that they are. There's sort of, Finland has overburden everywhere, right? That's part of the geological setting in Finland. So I would be pretty surprised if they weren't.
Okay. So is that so for you, that's not necessarily something that you specifically have to think about ways to dealing with, like it's kind of cookie cutter way to deal with that specific overburden?
Yeah, I mean, that overburden could be anywhere from sort of 1 inch to, I guess, even up to a foot, but probably more like 6 to 6 inches thick, right? And it's usually some moss you could potentially peel back, or or it could be a little bit larger, right? But that's pretty common. Like, a lot of the stuff in Finland is it's covered, right? And Finland's very underexplored, which is one of the exciting things, right? You have a first world country with a really friendly mining background, and they're and it's very underexplored, much like a sort of emerging nation, right? So, and part of that reason is that overburden that you talk about. So, that's why it's really important to look for boulders, look for pegmatite outcroppings, those types of things. That gives you sort of a starting point.
What do you mean that overburden is part of the reason why Finland is underexplored? Yeah, you can expand on that, actually.
Sure. Yeah, I just, like, if you and I were to take a walk out to just, somewhere in Finland, and sort of central or northern Finland, and we're not an experienced geologist, all you're going to see is sort of overburden, right? And coverage. So it's going to be tough for us to know where we should start, where should we explore, right? Now, some of the things that we could look for that would be helpful is some of the stuff that we've seen, which is ice direction orientation, boulders, right? Pegmatite outcroppings, right? But you really got to, when you find those, then you really have to sort of pull back that some of that overburden to take a look what you're seeing, right? So it's generally not some other countries where there isn't overburden, obviously is a little bit easier to sort of see what you're looking for.
Okay, so got it. So this basically falls within the concept of the easy stuff has already been found because it was easy. And then in this case, the overburden is kind of covering your target geology.
Yeah, I think there's multiple things going on in Finland. That's just one of them. The other thing is that it really wasn't open to mining until the 90s, right? So unlike, a country like, let's say, the United States, who's been, which has been, has a lot of exploration. It's been done to it over the last sort of 150 to 200 years. Finland, it's relatively underexplored, and people have only been exploring it for a short period of time, right? So, like when you come here, you can really see the opportunity. Like you can really see, how underexplored it is, and how you can still find world-class assets.
Why I'm asking these questions and where I'm coming from with that is because I was also thinking Capella, the deal that you got with Capella, there's a bunch of other companies that could have done that deal, but didn't necessarily do it. Like Capella needed money. They wanted to refocus the company because they have a bunch of stuff in the company. So why, like, how were you the first company to do it? Why did nobody beat you to it?
Well, one of our financiers and one of my sort of old business partners who I've had success with in the past in the lithium space, he had a relationship with Capella, right? So, he's the one who's sort of brought the opportunity for me to review. And, and obviously they had a comfort level with each other. And then that meant that I had a comfort level with Eric, and that it was a very friendly discussion early on. And I would say, that's probably the reason. But I would also say that, a lot of people were not aware of what was going on. Like I've been in lithium for 10 years, 8 to 10 years. And I could tell you every project in South America, project in Australia, projects in the US, but I didn't know about this mine that was being built in Finland. And it's significant. And a lot of other people didn't know either that I've talked to. So, from that standpoint, I don't want to say it was forgotten, but I just don't think that it was a place that was top of mind for people. So I'm not sure if that led to maybe a little bit less interest or just a little less conversation. But I think if anyone had known about this opportunity, they would have been all over it. But ultimately, I think this business is about relationships, and one of my partners had a strong relationship with Capella, and he had done stuff with them in the past. So I think that helped.
Jeremy, when I met my wife, I went to tell my mom, and I was like, she's great. And my mom was like, if she was that great, she wouldn't come to you. My mom and I bash each other.
Your mom has to give you more credit.
My mom's she can be a tease. Anyways, she said if she's that good, she wouldn't come to you. And that's kind of how I approach junior mining too. Like if the asset was that good, it wouldn't come to a small company or to one small company and then be taken out of by another small company. So that's where I'm coming from with these questions. That's kind of how I approach. That's my thinking behind it all.
Yeah.
Go ahead.
Yeah, do you mind if I jump in? I'm sorry to interrupt you, but sure. I would say this is the model in junior mining, though, right? I would say that a small company does do a deal with a small company, or depending on what you would qualify as small, but let's just say junior mining companies or micro cap companies, and then they have success in the exploration, they spend the money, and then they de-risk it, and that's when it becomes interesting to a larger company. So I guess I would sort of disagree with you a little bit on that, but I do understand what you're saying.
Well, I disagreed with my mom, and now we're 10 years later. And
good.
I was right. Well, it's why I'm asking those questions specifically, because what you're looking at right now has previously, well, some of it, it's large land packages, not all of it, but some of it has been looked at as well in the past. It didn't result in anything meaningful back then. So I'm basically trying to understand why you think you also have better odds at making it happen. So what changed? How are you approaching this differently?
Well, I think the lithium market's different now. I think the other difference is you have a lot of data in that area. You have a mine that's being built next to you. There was previous data on the property as well, and then also we have a significant discovery that we discovered from last year's program. So I think when you I don't think you can't really say this is the same project as 2, 3, 4, 5 years ago, or when we did the deal. Like this is de-risked or more de-risked now than it was before. And we've done, we spent $1.5 million last year on this project.
So when you say the lithium market is different, that's maybe something we can talk about later on as well, because the lithium market is not great right now. So it is different in the sense that there's maybe more demand, but at the same time, the price is also suppressing you guys as the juniors, so it's making your cost of capital higher. So that's maybe something we can talk about later on as well. But you're just reminding me of the work that you did last year, what you're going to be doing this year, and I believe you're doing bot or till sampling that you are doing right now. Is that partly infill sampling, or are you going to be just going to other parts of the property this year?
No, the work that we're doing this year is going to be to follow up on the discoveries that we had last year, and it's going to be to explore some of this new ground that we know of strategic importance and what we're seeing, and we expect to confirm additional lithium discoveries. So, and part of the trenching will be confirming drill targets, following up on that boulder discovery I mentioned earlier, and sort of continuing to de-risk what we've already found, and develop hopefully multiple drill targets.
Okay, so what were the intervals last year that you took those samples from? Like, what was how much space was there between samples?
Well, some of them are right next to each other, right? I think the way you have to think about it is we had a boulder discovery of about 1 kilometer. So, I don't want to say that all the boulders were right next to them, but they were close enough that you could say, we had 1 kilometer long boulder discovery, right?
Okay.
So yeah, it was significant, for sure.
But there's no need to go back and do, as I said, just infill bod.
No, I think right now you want to sort of remove some of that, or not think, but right now you want to remove some of that overburden, maybe do some trenching and see if you can find, that lithium bearing large pegmatite structure.
Right. Okay. What are you hoping the results would be here? Like, if you could just wave a magic stick and have the best case scenario happen, what would that look like?
Multiple large drill targets that you can show people that, hey, look, we have large structures here. Here's all the reasons we think we're going to hit when we drill, and when we do hit, this is going to be big.
What does that look like more specifically?
That looks like more samples to confirm more areas that are interesting, trenching within the boulder area the discovery that I've mentioned a few times, and then sampling those pegmatites and continuing to get similar grades that we got last year.
What I'm asking about specifically is mostly thinking grade wise, because what you got out of there last year was
the grade that we got last year was comparable to what you see within the area. It was anywhere from 0.5% as high as 4%. So that's pretty good. Especially if you had something at 4%, that's unbelievable. So,
yeah.
But you look at some of the other stuff that you've seen stuff work at sort of 0.5%, percent or higher is really good. So, I think if we have results that are similar to last year's results, we're gonna be very happy.
Well, with the size of the drill program that you'd go after this, would that depend on the results that you come up with, or can you already sort of give me a ballpark?
Yes, it absolutely would depend on the results for this year. But I think you're going to look at anywhere from a $500,000 to $1.5 million drill program would be. And I know that's a big range. I can't tell you exactly what we'd be looking at, but I think what I would tell you is that these holes are shallow and these deposits are very near surface. Like if you look at the caliber holes, they're like 150 meters, maybe 200 meters max. So drilling is not that expensive, and it's pretty shallow.
You actually expect drilling in a North European country to be expensive, but it's not. I've heard other ballpark figures. What are you thinking?
I would say that Finland is more expensive than North America. Absolutely, I think what you've heard is correct. I would just say that these are shallow holes. So if I said to you, hey, we got to drill a 700-meter hole, like if you were looking for, and this is totally off topic, but if you were looking at drilling in the Athabasca Basin in Saskatchewan for uranium. A shallow hole would be sort of 400 meters, right? Or you're drilling for deposits to 600, 700, 800 meters, sometimes even 1 kilometer underground, right? Where these are, you're hitting that structure like maybe even the first 50 feet, but the max depth of your holes is 150 to 200 meters. So that's why it's cheaper. It's just shallow drilling.
Sounds like this is going to turn into a pitch for Nexus.
No, don't think
I,
so. Don't
I'm
think
just
so.
kidding. That's for another day. I have been meaning to reach out to Nexus, by the way. I've gotten a couple of requests for that as well. Okay, so what would that specifically look like for you? 150 meters holes. How much is that going to cost you a meter?
I don't have that cost yet. We haven't got the driller contract. So hard to say at this point in time, but we'll definitely have that outline when we're ready for that program.
Ballpark, any of the neighbors doing something that you know about?
I don't have those figures with me now, unfortunately, and I'd also have to just look at what the assays and for the all-in drill cost would be.
Right. Okay. Good. Fine. Right. So now up until October, is that in terms of news flow? How do you think you're going to be coming up with news in the meantime? Are you going to just do all four things that I said? What I say, mapping, trenching, geophysics, geochem? You're going to have a news release for each one of those, or like how do you look at that?
I think it's going to depend on a few different things. I think the first thing is that we're going to probably talk about some of this new land that we've secured or in the process of securing when it's finalized. So that I think will be out here shortly. And then it's going to depend on the lab on the results, right? We probably do an update on what's going on, but if we get those results back fairly quickly, we may release a batch as we go along here. Or we may, as we did last year, would be to wait till the end of the year and release all of the results. But I think it's just going to really depend. We're going to have to sort of take a wait and see approach on this as far as what the exact press release schedule will be. But what I can say is that there's going to be a lot of press releases between now and the fall.
Or do you have again, I'm asking for ballparks or anything that you can be specific? Are you targeting like a news release a month or something along those lines?
Yeah, good question. I would say probably 1 to 2 press releases a month would be a reasonable target.
Right. Okay.
Yeah.
Fair enough.
I'd say closer to 2, but don't hold me to it. But yeah, I'd say minimum 1, maximum 3. So you're probably looking at an average of about 2.
I will hold you to it, Jeremy. I have to.
I know you will.
What about where I'm coming from with all that, or where I'm going with this is just trying to understand how you're going to tell the story in the meantime, because this is sort of a crucial point that you have to manage the capital prudently, that you don't spend too much of it, but you don't want to spend too little, because if a tree falls in the wood and there's nobody here, did it make a sound? So if you come up with something, you want there to be people listening to that sound, right? So how do you manage that balance where capital's limited, lithium market is not doing great, but you have to tell the story and you have to do all that work? How do you go and market?
Well, that's the $1 million question, right? I think, that's what makes this business so tough, is that you're always, managing, a treasury that you need to spend in order to create value, in order to work on your projects, while dealing with, commodity windows, commodity prices, the ups and downs of that, while dealing with also spending money on getting the word out there, talking to investors, trying to get new shareholders, investor communications, press releases, filings. So it's a challenge. There's no doubt about it. But at the same time, we have to advance these projects. We have to follow up on last year's discovery. We were in the working season now. So the good news is that we have close to $2 million in the bank. And we have in the money warrants of about I think it's about 980,000, but call it $1 million Canadian that expire in August. And our shareholders are supportive, so I expect most of those to come in, if not all. So I think our fiscal or financial position is quite strong, especially in comparison to a lot of the other juniors. It's as you probably know, it's been a pretty tough marketplace over the last couple of years. So I think the fact that we've been able to spend on our project and remain in a strong financial position is a rarity. And just to add one final thought on this, you can't find a lot of juniors that are doing work right now, as I'm sure you know. So the fact that we're coming out with work and de-risking and press releases, I think it differentiates us from a lot of the different junior companies out there right now.
What are you budgeting for G&A and marketing and everything included a month over the next 12 months?
Probably $600,000 for a year.
Per year, that's because you spent 600 grand on over the last 9 reported months on marketing based on that. on
Yeah,
that
marketing
filing?
G&A, right? I think, I think that's probably $500,000 to $600,000 a year, I think is reasonable when it comes to G&A, marketing, flying, meeting, going to conferences. I think that's a pretty reasonable number.
So
I don't know.
100 to 150 grand a month Canadian.
Yeah, I think
Okay,
that's
good.
now. Don't hold me to it. Things change. What's
Well,
the market look like? Do you cut back? Like it all depends, right? I think one of the things with these companies is you have to be flexible. You can't be stringent. You have to react to the market conditions, but at the same time, sometimes you don't have to react. You shouldn't react to the market conditions, and you should look at, okay, how are we creating long-term value for shareholders? But I think what is important is that you're constantly evaluating where you are, how can we do things better, and how can we be more successful?
that is true. There's nothing to argue with there. I'm just thinking about the financial situation here. If you spend, and let's be pessimistic about it because that's how we gingers are. But let's say 150 grand a month, that's 1.8 a year. You want to spend 2.5 on the entire exploration program for both projects and the drilling, 4.3. You have about 2 in the bank right now. You're about 2.5 short. Where's that going to come from?
Well, I mentioned the $1 million warrants.
Yeah.
So that sort of brings you to 1.5. But I think, the reality is that we need to create value for shareholders. Otherwise, we're not spending that 2.5, right? And we're paring down G&A. So if the stock isn't going up, I know it's had a pretty significant move lately, but if the stock isn't going up and you can't access capital and the market doesn't sort of like what you're doing, then you need to change your plans, right? So, and I mentioned the drilling, which is about, of that 2.5, about $1 million of it, just over $1 million. If we don't get the results we want, or if we can't access capital, then there's a possibility that we don't drill, right? So, and I think one thing I'd point out to you is the G&A it's probably not 150 a month right now. It's significantly lower, I think, than that. It's probably closer to that 100, maybe even lower, just because we've made some changes to a few things internally. And we're not currently in sort of a capital raising mode either. So, if you combine all that, I think we're fine.
What would you consider the market recognizing? Because you say if the market's not recognizing these efforts or it doesn't want us to drill right now and they're communicating that through the share price, we're not going to do it. What would recognizing it mean for you in terms of share price? Like what's too low to raise at? What is a good price to raise at for you?
I wouldn't look at it that way. What's too low, what's too high? I think what we have to do is just see where we're at. And, if you're taking it from a hedge fund, that's stripping a warrant, or is it someone that's strategic? Is it a strategic partner? I mean, those are different conversations, right? So, it's tough to answer these questions without more information. So I'm sort of giving you a few different hypothetical paths. So I guess I can't give you an answer on what price. I'd say that if you look at there's companies that are similar stage to us in Canada that have anywhere from 100 million market cap to a $400 million market cap. So, and I'm not going to name names right now, but so I think you can do the math on that. If we have 40 million shares out, is it reasonable for us to have a 50 million market cap? Yeah, I think that's reasonable. Based upon the results, and I think there's a pretty good argument, and I could still argue that we'd be significantly undervalued even at that price. So, that gives you, I guess, a guideline. But I guess what I'm trying to say is, I think at the current price, we are significantly undervalued.
So I like it when CEOs say we're significantly undervalued, because then I get to go back to them and with the question of, if the stock is cheap, why aren't you buying it? And I mean, why aren't insiders in the market supporting it right now? And do you have plans to do that? So yeah, let me ask you that question.
Yeah, I mean, that's a good question. I think right now, perhaps there's a period of time where we can't purchase shares for whatever reason, and I'm not going to go into that. But what I would say is that I wouldn't be shocked if you saw some insider buying.
Good point. And then come time to do a financing, that's I suppose, or hope, typically something that you as an insider and other insiders would be looking to participate in.
Absolutely, and we have participated in the past as well.
Good. I'm making more and more sense of what you're going to be doing here, Jeremy. What am I forgetting to ask you here? What should we be talking about?
I mean, this is probably one of the most thorough interviews that I've been on. So there isn't probably too much that you're forgetting. I guess what I would say to people if they're listening in is that, we have a company that's capitalized, we have a company that's doing work. I look at Lithium as sort of a long-term play at this point in time. I've seen the different iterations of stocks going up and down. I've seen the sales, I've seen the DLE projects, I've seen the South American brine projects, most of which have been purchased by now, including the last one I worked. I was running. But we've done this before. We've done it on 2 projects. We've had 2 projects taken out in the lithium space. We're very familiar with the players in the space. We're doing work to de-risk the project. We have capital, and it's a pretty low market cap. So I think those are probably the takeaways for me. And one other thing, our VPX, who's Mike Basha, he's done this before. He's had multiple large discoveries. He's brought in large multinational companies as partners. So, you're not going to find a better team, or you'd be hard pressed to find a better team, specifically in Finland where he's done it in the past.
Good. Well, Jeremy, this has been indeed, it's been a good conversation. I appreciate you being thorough with the answers as well. Hopefully we can do it in the future again and see what you've come up with over there in Finland. But yeah, it's been a pleasure. Thank you so much for investing your time with me.
Appreciate your time. Thanks, Antonio. Have a good day.